new kinds of data is probably located much more, which is around people's navigation of the digital world outside of financial services. So we talk a lot about the mobile operator data. That's clearly a big source, and we'll talk more about that. But there's other things. There's the social interactions in particular that are quite significant in a number of markets. One hears a lot about, let's say, for example, very high, unusually high rates of use of Twitter in Indonesia. Why is that? I have no idea, but it happens. The third is really not individualized data, but is market-wide data. And this probably is best described in some ways as the open data regimes that many governments are being pressured to adopt. That is putting much more of the government's data online and available. And so if you think about these three streams, they're digital. It's possible to centralize these three streams and to do analytics across all three streams of data in different and new ways that may open up new insights for many things, including possibly financial inclusion. So just to quickly illustrate with an example. Let me pause here. Let's say you had a farmer and you had these three flows of data about the farmer. What might you do with that information if you're a financial service provider? I'm going to start on the right. The satellite image might tell you how far they are from the market. In some markets, you can infer something by the type of roof that they have. Is it thatch? Is it corrugated iron? Actually, that's in some markets, that's an indicator of whether you're above or below the poverty line. Social interactions, who you socialize with. Remittance flows, of course, that's a very, very natural source of assessing that household's underlying cash flow and viability as an indicator of something much broader. Could you design a financial service around this? Could you find new clients if you had this kind of data? We'd argue that there's a lot of possibility. This is a little bit more of trying to think broadly around how a financial service institution might think about using data at different points in a customer's journey with a financial institution. The lighter colored box to the left is really around acquiring and finding new clients. And so if we have no data on them, it's kind of hard to find them. If we're starting to pick up some of these kinds of data, maybe it's giving us an indication about where we should look and which kind of customers we should acquire. And maybe it even speeds the acquisition process. We used to have people come in and fill out an application in a branch in order to acquire them as a client. Maybe we can skip that step and greatly speed the ability. But then that's just the acquisition stage. What if the customer gets an initial product, but we begin to learn much more about that person over time? Maybe they drop out, and maybe we're worried about them dropping out. Maybe we want them to drop out. Maybe they're no longer suited to our service. Could we begin to use data to figure out who's likely to drop out, who should drop out, who we may need to offer something better to? Maybe it's around simply raising the loan amount they might get, but it might be around adding a life insurance service or a broader suite of products, upselling, cross-selling to those same sets of clients. So I'm going to leave that. Let me just say here, we're trying to make a broader point that it's not just about credit scoring alone. There's a wide range of potential applications that financial service providers use. But let's talk specifically about credit. And so we're getting a little bit into a product discussion, which we will go into in more detail, and we'll talk about M-Shwari later on. But it's not only, interestingly, a credit product. There's a wider set of things that are involved. So why the focus on credit? We'll talk a bit about that during the panel discussion. But there are various reasons why credit seems to be a very early starting place for the use of some new kinds of digital data. So, as many of you know, in developing markets, 98% of the mobile phone users are prepaid users. They don't take a bill, they don't get postpaid, they load balance, $10, $5, and they spend until it gets zero. There's a problem when they hit zero. Their phone call stops, they're out of luck. Maybe they're away from an airtime dealer and they can't quickly sign up. That's a problem for the provider, and it's a problem for the customer, right? The customer is out of luck. The provider potentially loses revenue, and they potentially lose a customer. So there was a big incentive on the mobile operators to start offering very small amounts of airtime credit that would allow the consumer to continue to use until they had a chance to get back and load up on airtime. And in this process, I think there was a learning, and we've only become more aware of it more recently, but for instance, the Accion Group has invested in a company called Tiaxa, among others. It's a Chilean-based, is that right? Chilean-based company that actually, instead of having the mobile operator choose and fix what amount of credit for whom, actually goes in and does a specialized scoring for a number of mobile operators. I think they're in 12 markets now. I mean, it's become quite a wide-ranging business. They provide an interest-free loan of the small airtime credit, and it's built off of an algorithm, and they can provide enough value to the mobile operator around this that the mobile operator will share the revenue benefit from getting this service with Tiaxa. And so Tiaxa has a viable business model around this. This has led to, and again, we can talk more about M-Shwari and the exact genesis of it, but across a number of markets, it's led to the possibility that airtime usage or mobile operator data allows for some insights, especially around the initial client acquisition stage. Who can I get into a credit relationship? How much should I offer them in the very beginning? That doesn't necessarily solve the entire credit scoring issue for that client. It may be that once they're acquired, and if you go back to the customer journey piece, it helps on the customer acquisition. The behavior over time may allow you to rethink and add in different kinds of algorithms and scoring, use different new data. Their actual repayment history, savings behavior, provides you a new source of data that you can perhaps begin to get into a different kind of, and broaden the credit relationship with that consumer. So it may not be one algorithm, there may be several. Another element of this is some firms that are coming up that are just specialized in the data analytics piece. They actually don't do the lending. They provide the analytics as a service. So to take First Access as an example, not to say that they're the only one or the best one, but to use them as an illustration. The phone here actually represents a consumer. I'm sorry, it should have probably been a consumer, but we put a phone there. So the consumer can give their consent. Well, the phone gives the consent. No. We'll come back to the consumer. The consumer gives their consent via the phone that they're willing to share their mobile operator data. The bank extends that to First Access. First Access makes the query to the mobile operator. The customer's data, in this case, at least in Tanzania, maybe it's different, but it's the prior 6 months mobile airtime and other data from that particular consumer. So it's not an open stream of data. It's the prior 6 months. So it's a one-time credit score. It goes into First Access's algorithm. Whether it works or not is, I'm not suggesting it necessarily works, but this is the business model. They will then help set a credit limit with the lender, and of course the offer goes back to the client. Of course, this can happen pretty quickly if the algorithm works. I mean, it might almost be real time. And there is a fee arrangement that the lender pays to First Access, that First Access extends onto the mobile operator. So there's potentially a business model around this. I'm just giving you two brief examples to highlight the issues. So what are the possible benefits from all of this? So why do we care? What difference could it possibly make? We took a look at that in Tanzania. Now this is a busy slide, and I'm not going to try and go through all of it with you. And at the bottom is a link to the 80 slides that are on the web that you could go look at to find where these numbers come from. But let me highlight the 3B, the item at the bottom. This was an attempt to estimate the annual cost for an M-Shwari-like small credit line in East Africa. Comes out to about $3 or $4 a year. Of course, the credits are very small, which for a lender sounds fantastic. If you look at a typical microloan in the top bucket, it comes out to about $65 a year, but possibly with using some credit scoring to replace some of the information and services, we think we could drop that number by 20 to 30%, even on a traditional microloan product. Fewer visits from the loan officer, faster application, faster decision, a number of things. There are some similar numbers around insurance. I'm not going to go into it. For those really interested or masochistic, they can go read the PowerPoint deck. So this leads where we hope to get into the maybe more interesting discussion with our panelists, which is really, what does all this mean for financial inclusion? What are some of the big questions? And we'll pose three to stimulate a little bit of thinking in the audience, and as we move on to talk with the panelists. But is all that data really going to be useful? And when will it become more useful and available? I mean, I think there's some questions around how you share. Can you really glean insight from it? Some of those questions do need to be further tested. Clearly, there's something there. What kind of data, when, how it's used, we have to probe more. Is this an increment? Is this like just another additional thing that sort of helps us out, that derives incremental value, or is this a game changer for financial inclusion? I think there's some evidence that there is a game-changing element to this, and we'll hear more about that with M-Shwari. For a lot of other services and products, I mean, there may be some that it's more of an incremental piece for. How do we distinguish between those two different opportunities? And then, of course, there's the question around sort of the unexpected. What are the risks potentially to end users in terms, and also the benefits to end users around some of this? And we're going to get into some of these questions on the panel. So I'm going to stop there and invite the panel back up, and we're going to get going. I have, the way we're going to do this is I have some questions for each of them that we're going to go through in reaction to some of these framings, and then we're going to open up, once we're done with that, to a wider discussion with the group. All right? Oh, if you want to find out more, we have a focus note. I think it's sitting outside. All right, so to get us started, I think you guys can read in the bios. We have Jamal Rahal on my immediate left. Jamal has, 25 years of, not more. He told me last year it was 25, and the year before that, it's been 25 for a number of years. That he's had 25 years of experience specifically in credit bureaus and credit scoring, and you can see in his bio he's worked with a lot of the firms that are very well known in this space, the Fair Isaac, FICO, Experian, and he was actually on the lending side as well. He worked for the Renault car company, the bank that made consumer loans to allow people to buy more Renault cars, and of course used credit scoring very extensively in that process, and has recently ventured into the world of new kinds of alternative credit scoring around digital data, and particularly around the use of telco data. And so, Jamal, I mean, based on sort of what you've seen about reaching banked and unbanked customers globally, I mean, what's your reaction to this? I mean, how do you see new sources of digital data being used, and particularly how would it be used across a whole range of possible decision points for lenders and financial institutions?
All right. Well, thanks very much, Greg. I come to digital data with a slightly different angle. As an advisor, I am asked to look at specific problems, the development of specific systems, and in developing these systems, I have to look at all the data that's available, be it digital or not. Most recent development I was involved in was M-Shwari with my friend Peace Odengier here, where we developed all the analytics that power M-Shwari. But we don't want to preempt this discussion. Before I try to respond to this question, I'd like to position the canvas here of what was scoring before we went into the digital space, before we went into big data. Well, scoring, everybody in the US knows FICO. Everybody has to know their FICO score. FICO stands for the Fair Isaac Company, founded by Bill Fair and Earl Isaac. I had the pleasure of working for Bill Fair many, many years ago. And I think these two gentlemen from SRI, the Stanford Research Institute, invented pretty much everything there is in scoring. They started with new account scoring, application scoring. If you recall the diagram that Greg has shown, this initial relationship that you're trying to establish with a consumer in those days was based on application forms, and therefore we developed the first application scoring systems to assess. Many people use credit worthiness. I prefer the word probabilities of default. Whether we're worthy or not is a bit of a, yeah, it has a connotation to it. Let's say we want to assess probabilities of default or other probabilities, that is. Now, Bill Fair and Earl Isaac were very, very successful after a few years of hardships, because it was very hard to convince bankers in those days that a statistical system would know their customers better than they did. I mean, Bill was telling me about the very first times where he was actually shown the door by some bankers. And then scoring developed and went into all sorts of customer management related. We coined it behavioral scoring as opposed to application scoring. Behavioral scoring is a way to encapsulate customer behaviors. And what you're trying to assess there is probabilities of default on your existing customers based on the data you've accumulated during the relationship with them, yeah, transaction data. I've worked recently with a large number of banks who were still adamant about having their existing applicants, in particular SMEs, which are a tough nut to crack in terms of risk, filling out dozens of pages of application forms, and we had to convince them that the data they had on that SME account was a lot more valuable to them than any information that you would ever get on an application form. And it's a kind of data that allows you to be proactive. Why wait for the guy to apply? You have the data, big data, yeah, sitting on your file. Use it, score your customers, and go after the good ones and make them promotional offers. Don't go after the bad ones. So then scoring went into all sorts of different environment, cross-sell, upsell. You can develop scoring systems to determine the probability of attrition, the probability that the customer is going to leave you. That's important to know. Some of the approaches and the systems are still the same today. When you're wandering into the Amazon realm and you're clicking here and clicking there, you don't know that there are attrition scoring systems sitting out there watching every one of your moves and trying to determine when you're likely to log off. Yeah? Walk out of the store, and the minute that probability gets too high, bingo, you have a beautiful offer that's splashed on the screen to keep you in. Yeah. Just to mention this last one, because not many people know about this, but in many countries, the equivalent of the IRS, yeah, Internal Revenue Service, use scoring systems to determine what declarations they should be auditing or not. Probability of default there being the probability of having something to hide. Less ominous things now. Scoring has, there is no big financial institution today in mature markets that doesn't use a whole battery of scoring systems, application scoring, behavioral scoring, you name it. So then we go into digital data. I was brought into this realm by my friends at CBA. I was supposed to provide advices on the risk management side, and eventually we loved each other so much we ended up developing together scoring systems. Yeah, I don't want to preempt this topic, but what were the lessons learned? Yeah, and specifically when it comes to financial inclusion. Well, when I walked into this project with Peace and the whole team, I would not have bet a kopeck that, to say it bluntly, that telco data was going to be predictive of repayment behavior. Yeah? Let's say that at best I was agnostic in that matter. One of the enormous advances brought about by M-Shwari and by all telco-related digital finance initiatives is that telco data is predictive. It tells us something about the ability of the owner of that little telephone that Greg had in his slide to repay his credit. It's not the most predictive data you can find, definitely, and that's in all markets. Yeah? The most predictive data you can find is again and again and again, and I'm sorry to stress this too much, if I stress it too much, is the internal transaction records that you hold on your own customers. But telco data is substantially better than nothing. Yeah? And you have nothing. I mean, to be successful in all markets, a mobile-based finance service must not require application forms. The minute you start requiring application forms to be filled, you're defeating the purpose. You want instant decisions, and they're made based on telco data. So telco data is substantially better than nothing. It helps you make that first decision, and according to Greg's diagram, as you move into the customer relationship, and then the transactions, the relationship that customer has with you becomes the provider of the data you need to fire off your behavioral scoring system. The difficulty is, I will go as far as saying that today the challenge in developing digital credit, digital financial services is not analytics anymore. We have that under control. We know how to do it. We have developed approaches. Another, excuse me, to backtrack a little bit here, a big challenge of this type of initiatives is not only that you're looking at new data, you are also dealing with greenfield operations. They start from scratch. There is no historical data to base your models on. We've developed approaches to overcome these difficulties. So the biggest challenge today is not the analytics part, is not the data part. That has been explored. It works. Yeah? Challenges are in a different space. I won't elaborate on this, but Greg knows my opinion on this topic. It's really getting a telco company and the financial institution working together. Highly different corporate cultures, highly different expectations when it comes to what is successful. One will say, I want 55 million customers, while the other guy will say, well, if I get 1 million, I'll be happy. You know, trying to get these two type of institutions working together, in my experience in all markets, is very, very difficult. So I think I've taken probably too much time already. Let me continue. So that's as much as I wanted to say about M-Shwari and about mobile-based financial services. Coming back to an important point here, and this is the last one, farmers. Now, I'm doing a lot of work on, because most of the financially excluded that you find in emerging markets in Kenya, in East Africa, all over the world are farmers. They can't get the credit they need, and they really need it not to finance a TV set or what have you. They need it for investment purposes or for running their operation. It costs money to get seeds. Yeah? It takes money to buy fertilizers, and at times big amounts of money. So we've been doing a lot of work in this space, and my thinking is starting to crystallize there. If I were to spec the ideal database for farmers, the first one would be their transactions. These guys are doing lots of transactions that are recorded nowhere. They buy fertilizers, they buy seeds, but the limiting factor there is the limitations of the point of sale system that are used by the stores in many of these markets. And we are working, we have a couple of initiatives working with specific suppliers to improve those POS systems so we can capture transactions in electronic form and back them up into whatever CRM, Salesforce, or what have you. That's the primary source of data if you want to tackle the farmer's risk assessment. The second one is what Greg has shown is the weather. You need to understand weather patterns, weather forecasts. The third one is completely out of the picture today, and which we're working to try and bring it into the picture. One of the most important factors in farmers in emerging markets' success in economics terms is the quality of the soil. We've been working with a large number of laboratories who perform soil sample analysis. They do it, they produce a couple of criteria, 2-3 key parameters, one of them being the acidity of the soil. The acidity of the soil will determine to a large extent the success or the failure of a crop. And the success of a crop will determine the success of the farmer and his ability to repay a loan. Yeah? That data exists. It is in digital form. We have to find ways to grab it and centralize it, but we're dealing with competitive factors here. The different labs don't want to share data. The good thing about soil analysis is that you don't need to do it on a farm-per-farm basis. Once you've done it in a given farm, that soil analysis pertains to the whole area that surrounds the farm. Couple of last words. One about big data and about scoring compared. We have different approaches. Yeah? Big data is about the Alibaba increasing sales, yeah, and firing off whatever hundreds of thousands of variables they can find in the database, in their database, transaction databases, to increase sales. In credit, you want to understand your system. You want stability in those systems. Your scoring systems are there to last for a reasonable amount of time, whereas in big data, sales-orientated approaches, you have a tendency, I'll use this word, it's a bit strong, but you have a tendency to go for Kleenex scoring systems. You use them for a period of time and then you throw them away. So the methodologies, the algorithms, the approaches are the same, but the way you use the scoring systems, the way you watch over them, the way you monitor them, the frequency with which you replace them is different.
Jamal, thank you. There was a particular strain there around different sources of data. We heard about soil, we heard about weather satellite, we heard about mobile operators not wanting to give up their data. So part of it is that some of the data is becoming available, but it's not yet figured out the way to structure the partnerships that would allow financial service providers to leverage that data in an appropriate way. Let me circle back, though, on the particular one that you alluded to. Mobile operators we sometimes hear and think about, wow, why do I need a bank? I can go and start to do this by myself. I'll set up a little finance company and run it off that balance sheet. I mean, why do I need the bank anymore, right? I mean, that would be one reaction. Maybe that's part of the challenge in the relationship. On the other side, the banks are sitting there and saying, well, you know, I'm the regulated entity. I can raise deposits. They'll never be able to compete with me on that side. What's this mobile operator data anyway? I mean, it's such incremental small value. I really don't need it. Maybe you could just say a few words on how you alluded to the challenges there. How do you put those two different partners together? Maybe just a few words, because I know you've been in a few discussions, and you don't have to share with who. But where, you know, how do you start to have that discussion?
Well, I think you have to be very transparent with the two players. First of all, you have to set expectations on an equal par. I mean, M-Shwari has been a tremendous success, and I'm delighted to have participated to that success. Successes have a downside, which is that they set expectations to unrealistic levels. So new operators, telco operators who go in this field expect to have 7 million customers in 2 years' time. It's just not the case in many markets. So you have to set expectations. You have to make the two partners understand what infrastructure they have to put together to be successful. And the minute you explain that to them, they sit down. Some of them will just say, ooh, we thought it was a fast way to make a buck. No, it's not. It requires investment. It requires putting things together. So being transparent, explaining the challenges in terms of infrastructure, and explaining, this is crucial, and to your point, Greg, is really explaining the precise roles of the two institutions. They're not carved in stone. They can evolve. They can be slightly different depending on the market, but you have to help them carve the different roles they want to play. And once you've gone beyond that point, then you start creating the type of synergies, but it's never an easy ride. Again, most often, I'll just conclude on this, Most of the mobile finance services that don't see the light today don't see the light not because of any analytics or any scoring challenges, just because the two guys don't manage to work together.
Thank you, Jamal. We're going to transition to our to the next panel speaker, and Kate McKee is at CGAP, and of course, I first got to know her as the head of the Office of Microenterprise at USAID. But before that, had worked at the Ford Foundation in West Africa and New York, and was, of course, part of a large community development financial institution in the U.S. for many years. So, but Kate, you're coming at this maybe from a number of angles, but maybe there's the consumer protection angle to all of this. And I think the question is, how do we begin to think about the potential benefits and the potential risks to consumers of this kind of data and this kind of service delivery? How do we begin to ask the right questions?
Thanks so much, Greg. And I obviously don't spend enough time in bars because I'm not really comfortable trying to balance a microphone and my notes and speak to all of you from this little device here, which is quite tippy, actually. So a little known fact around CGAP, I actually designed a credit scoring algorithm in 1997 at the Community Development Financial Institution that I worked at in North Carolina. It was very primitive. And one of our goals actually in the advocacy work that we did around this was to show Fair Isaac that taking into account medical collections of low-income households was both very, actually had unintentionally discriminatory effects on those households and was not very relevant for predictions. And it was really hugely important in U.S. financial access when Fair Isaac, whatever they did to inside the black box to change their treatment of that variable. So I'm very, very aware of the benefits of this kind of work. I think the focus note summarizes them quite well, and Greg's presentation brought out a number of them. If you think about the farmers that now can have access, they were, in credit scoring parlance, they were no file. They weren't even thin file. Or thinking of the Fair Isaac example I just gave you, it was the wrong data points were being used. So there's a lot of potential to getting this right. I think there are potentials in terms of the offers themselves, their pricing, their features, the possibility of customization to different nano segments or even individuals, the possibilities for financial capability, and for including, this might include third-party provision of financial advice at a much lower cost to low-income individuals, but also a sort of a self-service model. If I had access to my own data, and I know Paul is going to speak on this, in an organized way, could I choose and use financial services better? But there are some risks as well. And our job in financial inclusion, I think most of us in the room would identify with, as we are financial inclusion professionals, is to try to optimize the benefits and the risks, to look at the trade-offs, look at the synergies, see how they can best be addressed. And that, I bet, is a core part of the business that you're doing, Jamal. So I have been talking about this in kind of hypothetical terms for a while, but recently I had the opportunity to go and do some consumer research on the ground in a Southeast Asian country with customers of a bank who had received pretty much out of the blue, without having made a specific request, a credit offer, an offer for a consumer loan. So you receive it as a surprise, privately, and without having really thought about how you're going to use it. And in order to avail yourself of this, you agree to give access to one of your social network accounts. Really for what consumers thought was it was to help fill out the form, but of course it was being used for scoring as well. And as we interviewed these customers, we were interviewing successful customers, unsuccessful customers who had not repaid their loans, those who had paid off fine, but they were in the attrition category, This wasn't really, they decided what they needed. Maybe they were curious, which I think is a theme that's going to come out in our next panel. But some had gotten into trouble from this kind of loan. And there was very little understanding, actually, of the terms and conditions and how it worked. And so we were there because the lender had asked us to help work on these points. They wanted high repayment, and they wanted customers to understand what they were getting into. And I think that I'd like to then use this to kind of frame 5 questions, and I have my own personal predictions about what's going to happen in those areas. So the first question is, do people care about the privacy and protection of their personal data? And will they care over time? And currently, I think it's pretty clear that if I'm a consumer in this particular market I was looking at, or in Kenya, or in Tanzania, or in Cote d'Ivoire, other places where we see these products on the ground, even if it's well explained to me, and the first access example is one that was well explained, consumers will choose to get the loan generally. And the risks of their data being, what happens to their data, they're a little bit confused about it. It can be explained. But those seem kind of distant, not very salient to them. And so I think we can, with some confidence, say what choices they'll be making now. That is not to say that we really understand concepts of financial privacy, that we really understand underlying preferences. And in fact, one of the big arguments for mobile money from a gender perspective is that it's empowering to women to be able to have private finances. So I think we need to probe this question a whole lot more to understand it. And I think we also need to anticipate and to be monitoring how attitudes change. So once I've gotten the loan, once I've been offered the cross-sale of other services, would I make the same choice? And is there any way then for customers to exercise their choice based on their evolving understanding of what is happening here? So I think this is one important question that we need to probe that focuses more on the demand side, attitudes, and perceptions. Second question, what are the specific challenges from a customer risk perspective, which is what I've been asked to speak to, in the short run and in the long run? So I think in the short run, the biggest challenges are around credit, because that's the current kind of driver of the use of data of bigger data for financial inclusion. And so questions arise around accuracy, around profiling. I'm in essentially a zip code in Nairobi where over time the lenders in the market are going to be able to tell that repayment is lower. Or I hang with friends who have poorer Facebook credit scores, if you think of it in that way. So individually I'm being profiled in a way that's not to my advantage. And really credit scoring is about discrimination. It's about discrimination for multiple purposes, and I fully acknowledge that it can be discrimination for good purposes, but we need to think especially about the accuracy of the data, the potential for profiling, and whether consumers understand the consequences of non-timely repayment of the credit footprint that they're creating. This was certainly not the case with the consumers that we were interviewing. And I wonder in the early, the Kenya market has evolved a lot, but I wonder the M-Shwari customers, I know it was traumatic for everyone when over 100,000 customers had to be reported to the credit bureau, the brand new credit bureau, because they hadn't repaid their loans. And what are really the consequences of this over time, and how should we address it? In the longer run, but not too far from now, I think the main challenges will be around data privacy and security, which are closely linked. We may say people don't really care about data privacy, but they probably care about identity theft, and they probably care about frauds that can be perpetrated through misuse, unauthorized access to their data, including by governments, which is something we really need to be thinking about, an assumption of benign governments. I think it is pretty accurate, and you might correct me, Jamal, if I'm wrong, but that if a government entity walks into a telco and says, for security reasons, national security reasons, we need access to all your data on these customers, it's pretty likely they will get it. And so one could imagine scenarios where this might be problematic for customers. And as we think about also data being, it's a natural resource, but who's exploiting it? So data being appropriated and commercialized, and essentially consumers are losing an asset that might have value, but they don't know it, and it's now appearing on the balance sheets of other entities who are certainly talking about data assets. And obviously the security and authorized access issues get more complicated as the value chain extends. So a third question is, will traditional approaches to data privacy and protection be adequate? And my prediction is no. If we look at particularly the reliance on informed consent as a model. Now, the first access case is the simplest case. It is single use by an entity. It's anonymized data, single use, not stored, and at the moment not used for other purposes. So that's the easy case, and we found that you could make informed consent somewhat meaningful, although as you engaged with customers, they had more questions about it. Another example would be, think about what we know about PIN use and the current methods of trying to establish meaningful data security protections. So I think we're going to have to really give this some thought. So the fourth question this takes me to is, will technology offer some of the solutions? And here I am quite optimistic that privacy by design could be, if it were prioritized or even valued, built into some of the business models, and actually might be easier to do it at the beginning than later on to have to retrofit. And so there are some encouraging solutions around tokenization, the new generation of biometrics. Michelle here, one of my colleagues, her bank now, to authenticate her and protect against fraud, she uses voice recognition and sends a photo of herself from her phone. And it is indeed Michelle. And that, when we think about how user-friendly and intuitive it is, that might be a good thing that could come. The question I have here is how much can get built into $30 smartphones, for example. What kind of encryption and security measures are possible, or what can get built into protocols in the value chain? There are definitely some promising solutions by individual firms, and there's some promising initiatives by industry bodies, like the new GSMA code which is a self-regulatory measure, has strong privacy principles. How they'll be realized is, I guess, to be seen. So my final point I want to make is, my final question is, will industry, even with these solutions and self-regulatory measures, go far enough to satisfy us and society, if you will, and protect consumers? Here, my prediction is probably not. Regulation will be necessary. The regulation we see is probably not what we want because it's a problem for firms and it's not very meaningful for consumers. So I hope we could work together and maybe take a cue from the industry self-regulation in a dialogue with regulators to come up to something that's more meaningful and enforceable. And I want to close just with a quote from something that I thought was pretty powerful. It was a Slate article by Evgeny Morozov recently, and future tense. And it's about privacy and security haves and have-nots. In yet another paradox of the modern age, the rich people are spending money on expensive services that protect their privacy and improve their standing in Google search results, while the poor people have little choice but to surrender their privacy in the name of social mobility. I think we can find some better solutions if we work together. Thank you.
Thanks a lot, Kate. I think she's laid out a series of questions that start to move us down the road around what are the right kinds of questions to ask about the benefits and the risks, and how we get some answers to some of those questions over time, I think is an important challenge for all of us who care about this issue. In the interest of getting to the Q&A, I'm going to move to our next panelist, Paul Brailoff. Paul is a reformed lawyer. Is that right? Yeah. And recovering lawyer. Recovered. So Paul and I first met wandering India together, yes? And Paul joined CGAP for a period of time after being head of new product development for SKS, after being at Mayer and Brown and doing lawyer real estate advertising work in the U.S. But has made a career out of financial inclusion since then, and particularly in the last, I think it's a 2-year-old, the Axion Venture Lab. Almost 3. Paul is the founder of, he's the managing director of, and as a result, he gets to see, coming across his radar screen, a whole bunch of exotic companies that are playing in this space, some of which he can talk about, some of which he can't. But Paul, I mean, given all the things that you see, where is the use of digital data headed? What are some perhaps unexpected or surprising things we might begin to see down the road?
Great to be here. I'm going to try to sit and talk at the same time. We'll see how this works out. Greg will catch me. Paul. Yeah. It's pretty comfortable up here. We've talked a lot about big data with a lot of hype and a lot of excitement, and it's so big and scary, and iPads are stacked to the moon, and a lot of other things are happening. And God knows, as a sort of venture capitalist in this space and as someone who wants our companies to succeed, we play a role in generating that hype because we genuinely are excited about it. But I think the way that we can think about it to take it down from this big monolithic terabytes, yottabytes, gigabytes, whatever it is that's out there, we are really looking at a world where there's a lot of new data that exists that didn't exist before, and there are new analytical and technological approaches to making sense of that data. So I manage an investment fund. We invest in startups doing cool things in financial inclusion around the world. As we look at it, it's not necessarily big sweeping changes we look at. It's looking for those little pockets of changes, often driven by digitization of data that makes it more accessible. If you look at Latin America, where more and more invoices are required to be digital, it's more of a revenue authority thing, but that gives us now a data trail that we can look at when we want to lend to small businesses. If we think about the rise of small business accounting software that is all hosted in the cloud, as more and more people are using Sage and Xero and Intuit and all these places, that is data that now can be mined, that's really updated, that's pretty reliable, that you can access from a distance and make offers to small business customers that we never had before. Digitized purchasing histories, looking at the way in which you can look at a Unilever or a Serengeti Breweries or Airtel's digitized purchasing histories to see how long has this particular distributor or retailer been around? What are the volumes that they're working? That's all information, interesting data. Mobile money and the rise of that, and we've already talked a bit about that. So to take it down from this high level, it's really looking at these new pools, new niches of data we can mine. Probably the biggest trend underway is the expansion of internet and social media. I think that when we started Venture Lab 2.5, 3 years ago, we would talk about, yeah, we're going to invest in internet-based businesses. And everybody said, that sounds crazy. No poor people are online. No poor people can access the internet. Nobody seems to think that's that crazy anymore. We're still early. There's still a ton of customers that do not have access. But if we look at the work that Facebook's doing with internet.org, if we look at what Project Loon is doing, anyone seen this Google X? There's going to be weather balloons floating in the stratosphere that are cascading Wi-Fi coverage to all of Africa. I mean, it's crazy, but it opens up access. Smartphones are picking up pace at a way never before. So I think we look at these big ideas and get excited and look for investments that we can invest that are taking advantage of that. At the same time, I would emphasize we are really, really early. I mean, this is not a realized vision yet. This is not a realized thing to figure it out. I think a lot of the applications that we see, at least with the companies we invest in, are quite boring applications. It's things like, help me understand that this person that says they are who they are is actually who they say they are. Help me understand like whether this person actually works where they say they worked by like cross-referencing LinkedIn or Facebook, or that they're not signing in from an IP address in the Ukraine or wherever. Those are really valuable data points that don't get us into this futuristic 1984 scenario where everyone's black boxing these credit scores and making miracle decisions about credit. No, this is pretty boring stuff. But these are really hard challenges. ID verification in a lot of emerging markets is terribly complicated. I'm figuring out if someone actually works where they say they work, terribly complicated. Having people fill out form after form after form is really quite off-putting and loses a lot of people in the process. So if we can use big data in that way, I think that's exciting in the short term. But as we look, I think, more longer term, we're looking at all these startups doing really cool things around the world. And I think fundamentally, we think startups are very well poised to push the innovation frontier in financial inclusion. They're nimble, they have low cost structures, they can change on a moment's notice. They're totally disinvested from the status quo. How many times have someone tried to innovate within a mobile operator or a bank, and then they get shut down because somebody in some other department is worried it's going to impinge on their business, et cetera? Startups don't care. They want to disrupt everything. I also think there's incentives that are more aligned to the long term. No one cares about their quarterly numbers to make their annual bonus. They care about 5, 10 years out how they're going to change the world and all become Mark Zuckerberg. So it's a very different kind of risk calculus that startups have. And we see them doing a lot of things across a number of different functions in this data, value chain. Aggregating data that people haven't really looked at before. We've invested in a company, Demist, that essentially does an automated 30-minute intense Google search in a microsecond on customers and can pull in a bunch of relevant data. And it's being used very efficiently not to create credit scores per se, but more to verify identity and employment and things like that. Destacame in Chile, that's organizing a bunch of utility, mobile data, trying to create sort of an aggregated place for all of this. Analytics we've talked about. First Access got mentioned, who we've invested in. Signify. A number of others who are looking at Minds is another new one. Looking at interesting way we can analyze this data. I completely agree with Jamal. I actually don't think the analytics are the hard part in most of this. It really is the putting the pieces of the business model together. It is getting access to that data. But still, we're getting, I think, the industry inspired around some of these opportunities. Startups are using data in ways that people haven't before. Copo is a company of ours, and they're just starting to use the payment processing data. They go out and they help merchants accept mobile money. They're using that payment processing data so that they can more efficiently lend to these merchants who are starved for capital. Or Inventure out in now in Kenya, sort of changed markets from India. Changed their business model, and now they're actually putting apps on customers' phones that let you learn about the customer, download data from the phone, and track ongoing usage in a way that's really pretty creative and lets them lend against that in a way that people haven't really done before. And then generating new data. And I think this is something that I want to sort of linger on. Technology has put us in a position where customers really can take control of their credit identities in a way that we haven't really been able to before. Technology has made it possible for customers to go out and create information on them that didn't exist before. We're not just in a regime anymore where these big institutions collect a bunch of retrospective data on what you did in the past, and then that's the story on you. You can now do things proactively to augment what you look at, or what you look like to the outside world. So some examples: Entrepreneurial Finance Lab gives people psychometric tests that they can then those can get graded to get a sense of your work ethic, your integrity, your honesty, your intelligence. We've got companies like a new company that we're looking at very closely in India that is actually using data to mine customers' credit reports and then make suggestions for how customers can proactively rehabilitate certain things, fix things, add data in, opt into different regimes so that they are more likely to get credit in the future. I mentioned Inventure, the opportunity to download an app that just basically tracks your information for you and organizes your information, similar to a First Access, but a little bit different in that you don't have to then go to the mobile operator as the keeper of data. Sort of acknowledges, hey, you the customer, you have this. We've invested in a company, Revolution Credit, which I think is very exciting. What they do is they give customers who are applying for credit the opportunity to watch a short, informative video about how credit scores work, how to manage their credit accounts, budgeting. Watch this video, take a test, and then get some sort of offer. Let's say an application fee is waived or something like that. This data is then mined, and this interaction is then mined for insights that can lead to better credit decisioning. And this is primarily being used in the US today. And so there's this vast middle of FICO scores where you really can't tell. You know there's a lot of good people in there, you know there's a lot of bad people in there, but you can't really tell who's good. Even at just the level of, did people decide to do something proactive and take this test and watch this video, even that has been shown now to be pretty predictive. And as we deepen that, as we take these automated digital interactions and mine them, I mean, they collect 250 data points on every one of these 10-minute interactions, more and more can come out that I think is interesting. So we're really excited about the power of this generation and the way startups can help us organize more information. Taking this a step further, who ultimately owns this data, right? I mean, as we think about whether you've repaid your credit card bill, how many balances you have, how many times you called somebody last month, how many friends you have on Facebook. The regime we exist today is largely one because of technological limitations where that has to get organized and aggregated and centralized in these repositories like credit bureaus. And I do not believe that credit bureaus are going anywhere for the near term. At the same time, I do believe we're in an exciting era where customers can take more control of their data. Customers can organize this. Think about how most of you in this room probably have smartphones and you've heard of applications, apps. And when you log into an app, most people aren't even like setting up usernames anymore, right? You just log in with Facebook. You log in with Google+. I think we'll probably, sooner than we think, get to a point where we have some sort of credit passport type thing that when you want a financial service, you log in with your credit passport. That is a lot of data that both is your data that tracks your credit card spending on Mint. It tracks your social media, your social graph. And in fact, maybe you start playing like Lumosity type games and you do all this stuff, and all of this goes into this big credit profile that is yours, that you give to people when you want to get something out of it. We think about this concept sort of as an evolving credit bureau of one. No more like the digitization, the decentralization, it enables this ability to take control of your own information. I will wrap up in a second. I think the one other point I would make is we are really early. I like what Kate said about these open questions, these risks. I think it is so early that I don't expect we would have gotten further than we are today. But the work we have done today, to date, has largely focused on the business case for providers to use this. It has largely tried to understand, are there benefits to retention? Are there benefits to lower credit losses? Can we say yes to more customers? So this business case has gotten a lot of attention. I think the impact case, it's too early to probably, but needs to start getting more attention. We need to start asking at a more sophisticated, deeper level, how is this good for customers and what are those trade-offs? I think that we've contented ourselves that in general, all this data is going to differentially affect people who don't really have scores yet. If you already are, 750 FICO and you have 25 trade lines open and you're in great credit standing, who really cares if someone adds back in your social graph? The hypothesis is this is really relevant for thin file or no file customers, people that are credit invisible. And we're just starting to then ask that question, does this really work? It makes logical sense that this data will let us say yes to more people. And access is good. It makes sense that we will be able to better assess risk and thus price risk better. That hopefully leads to lower costs for customers. It makes sense that we're going to be able to make valuable recommendations that let people take charge of their own credit profiles. But very little of that has actually been validated. There was just a study last week that PERC put out. I think it was in the last week. Could be I just found it in last week. But a study where PERC for the first time tried to take a look at how does this actually benefit credit invisibles in the US and came back with some very positive findings. But we don't have a lot like that out there yet. And again, we're still very early. FICO, I don't know if this was an April Fool's joke. I don't think this was an April Fool's joke, but it came out April 1. But they are now incorporating alternative data and rental payments and utilities into their scoring for the first time. So we're very early. I do think a lot more work has to get done, but certainly we're excited about the power of startups to help push out that frontier and try these new models.
Thanks a lot, Paul. Wow, there's a lot happening, and I think to sit in Paul's position to see a lot of things coming across your radar screen is a real privileged position. Of course, I think the point is not all of these businesses are going to succeed, but the ideas may succeed. So even if we get 1 in 10, the business flying, maybe they're starting to illustrate what is going to be a new idea that's adopted by a mainstream large corporation, or maybe the startup makes it on its own. I think in the interest of time, I think we're going to transition to the question and answer session. So I'd ask everyone who has a particular question, but let me just sort of make a comment on a couple of cross-cutting themes that I heard across all 3 panelists coming out of this. First of all, that I think it goes without saying that information is just vital for financial services. Getting information and more detailed information on our end customer is vital. Otherwise, we're just offering a product that we have no idea whether it suits that end consumer. And we've been through that with microfinance, right? It doesn't meet a lot of people's very specific needs. And so the more we know, the more we can better choose who's getting what and how they get it. So I think that's just vital for driving better impact in financial services, finding the right clients. So that's one piece. The question around how we get the data, though, where it's coming from, I think those questions are largely unresolved. Yeah, we know there's a lot more data out there. How we commercialize it, bringing in, get providers to start talking to each other and using it, that's really where the challenge is. It's not well, also here, in the algorithm itself. That's something the analysts can figure out, and that will change over time. And by the way, anybody I ask for their algorithm just looks at me and laughs at me, so I've stopped asking. Traditional sources of information, credit bureaus and other things, are still vital, but they may start to get disrupted and displaced in some markets. And of course, we know in a number of markets, credit bureaus simply aren't there or don't work. And so does this become a substitute or a replacement for that? And then finally, this question about the value of the data. Is it for the provider and commercialized, as Kate was alluding at, and clearly there's a use? Or is this something that's ultimately going to benefit the consumer, and do they own it and control it and drive the discussion? I think therein lies the tension across the provider and consumer spectrum. So there's just some cross-cutting comments. Let me turn it over to the floor, and whoever is taking the questions from, we'll do that next. We're not having questions come in from? Okay, all right. So let's go to the floor, and maybe if I could ask, just keep it to a question. It'd be great to know who you are, and if you want to direct it to the whole panel or a specific person, that'd be great. Stand up. Yeah, there are microphones in the alley here. So.
Said, I'm going to start us off a little bit because I know people are trying to formulate their questions, and this question is really about having these kinds of developments happen in a range of different political contexts. So I'm coming at it having worked in data for a pretty long time here at the U.S. and having had the history of working with a lot of .coms way back in antiquity who were trying to do similar kinds of things. Here, when you're collecting big streams of data, you're doing it in a context where there's recourse, there are constitutional rights, there are regulations. There's a whole infrastructure that basically constrains or corrects the misuse by government, right, or other kinds of entities. And my question is, do we need to have a different set of filters when we're having these very interesting, I think, and ultimately positive developments happening on the business side, but do we need to have a different set of filters when it's happening in a context where you have governments that will use the data in ways that are really quite tragic and dangerous? So that's the question.
So maybe we'll take another question or two from the floor before we go to address that.
Hi, Sarah Parker from the Center for Financial Services Innovation. So having worked in the international space for several years, we know that there's no really developed credit scoring model like we have in the US with FICO. And so this use of alternative data, big data, is kind of like just grab it because you can finally score people who aren't scorable. In the US context, it's been interesting to see how FICO scores are this black box that no one really understands. They've kind of, while they were initially, while they were initially put out there as a way to assess risk, they've kind of evolved into this assessment of someone's overall financial situation in a way that can discriminate in a positive way, but also in a negative way. So I'm curious, with bringing in big data and alternative data in the U.S. context, but I guess overall, it looks like the big black box might just get bigger. It's all these other forms of data that people don't quite understand. So I love your point, Paul, that consumers can take control of their data, but how do you actually see that happening in reality? People need to understand what affects their credit score. I don't know if they really understand. And we see that changing, like the FICO pilot with alternative data, or even credit cards, like showing people's credit score on their monthly statement. But the risk is that this black box just gets bigger, and all these other sources are brought in, and consumers are even more confused about how they're scored. So can you talk practically about how we can avoid that?
Yes, we'll take one more question before we go to the panelists. Yeah.
Hi, I'm Amrit from IMTFI at UC Irvine. And full disclosure, I also worked at the cashless loan product that Paul talked about. I work for Copa in Kenya. My question is specific to Jamal. It's a very specific tactical question. You talked about this misalignment of incentives with mobile network operators and banks and how they're very different institutions by their very character. In your experience, what are these incentives that help them bring together? What are these shared values that help them kind of sit them at the table and say, all right, you can actually work together? Because that's something, it's making two elephants dance, so it's hard. Thank you.
So are you guys ready to speak to the broader FICO regulatory question first? Kate, Paul, do you have something to say?
This is definitely Kate's domain, so I will defer to her. I think these are really, the rules of the road question around this, I think, are very interesting. And I do think that in many areas, the black box is just getting much bigger. I sit through a lot of pitches from a lot of startups that use machine learning and throw that around a lot, and then I ask for a clarification of what that means, and no one can describe it to me. I have no idea, but it sounds really scary and awesome at the same time. Don't really know. So I do think that there is a risk of the black box getting bigger. I do think that we'll probably need to start seeing more regulation like the FCRA that exists in the U.S. In other markets. The Fair Credit Reporting Act here is pretty detailed about what information can be used in what way to make a credit decision. And specifically, there's a lot of information that's not deemed contestable enough, clear enough, reliable enough, whatever else, that we don't think you should get turned down for credit or a place to live or whatever based on that data. I do think it's very likely that things like that are going to have to get applied in other markets. In almost all cases today where this data is getting used, it's being used to say yes to more customers. The business case for providers are to maintain the same risk level, but say yes to more applicants so you can increase customer base, increase revenue. So today, I think this is having positive access things. That could turn on a dime. That could change very quickly in a lot of different environments that this gets used in ways to discriminate. How concretely do we do it? I don't know yet, and I don't think we've seen enough. I do think that figuring out models where at least small bits of data that you can verify, that you can say, yes, this is my Facebook profile. Yes, this is my LinkedIn account. Because the companies we invest in often don't know. Like DMIST, when they find a customer online, there's kind of a credibility score. They're like, we're 45% sure this is the right John Smith on Facebook. We'd at least get to 100% if a customer said, yes, this is me, and I'm going to give you my Facebook, I'm going to give you my LinkedIn, I'm going to give you my cell history, and this is all me. Now, the algorithm behind that is probably going to continue to be a bit of a black box. That's probably where eventually we're going to need some protection, but I hope that in the short term we don't cut off too much of the access benefits to customers by jumping the gun, perhaps, on that. But no question, we need more.
Kate's next, yeah?
Yeah, let me just pick up on a couple of the questions and the point Paul was just making, and actually the question to you, Jamal. So I've been in these conversations about we own the customer, no, we own the customer, no, we own the customer. I think we need to establish, does the customer own the customer? maybe the mobile phone owns the customer, but do the mobile phone and the customer own their data, and in what way? What does that really mean? And I'd like to see Greg's, your nice diagram extended to recognize that part of the way the data is used is it's sold to others. So there's a nice little quote I saw that all data is credit data, all data is marketing data. The asset, someone is going to be interested in that data. And so that's part of what we need to look at is the sale and trade of data. And that's, so that I think what we need to do is really define a small number of very meaningful things for consumers that are actually tied to either to potential financial losses or other harms. And the predatory government is definitely relevant in some contexts, and we need to really pay attention to that. And then we need to really look, what is essential to the business models working? Are there some better ways to square the circle and have maybe shared ownership as a concept, but with some protections for the customer?
Jamal, as the creator of one of the black boxes or some of the black boxes, how do you respond? And maybe also to the telecom question, both questions.
Yes. Well, what you have to understand is that scoring systems are statistical in essence. So asking why does that scoring system assess this person as being a 5-star or a 4-star or a 3-star, I mean, you can get a glimpse about the reasons why if you know the algorithm. But again, we're talking about statistical systems. The scoring system has identified that you belong to a category of people who on average had a probability of default of whatever, which makes you a 5-star or a 4-star. Again, I mean, it's maybe FICO over the last years have not communicated well enough about the way they develop their systems, but even with the best intentions in the world, it's a little bit hard to really explain what, especially when you're talking about those credit bureau scores. FICO score is sitting on top of huge amounts of credit bureau data, be it the Experian credit bureau data or others. You're looking at hundreds of variables going in that score. Identifying why precisely this variable has played this specific role in your specific case is a tough question to answer. We're talking about statistical systems. There is another aspect to it, which is the competitive edge. I mean, every one of those scoring systems developer, me included, think their scoring systems are the best thing ever developed, and we're not all that eager to share that know-how and that knowledge with our competitors. The question raised many, many years ago because in the UK we had this Office of Fair Trading that made it mandatory to explain the reasons for rejection of a credit applications. So you can't tell the customers you've been rejected because you score only 70 and our cutoff score is 75. So we had to put together intelligence behind the systems that produced the letter of rejection, so they would select those variables where that applicant scored the lowest by saying, okay, I mean, you've not been for very long at your address, etc., etc. At the same time, you want to be careful because the more information you give, the more consumers out there will understand the content of your scoring systems. And then you can be assured that the application forms you're going to get in are going to be very, very were precisely structured to pass the cutoff score. So we are in a difficult space, analytics. Yeah, it's not easy to provide answers. We could certainly do a much better job at communicating how this, you call it black box. Yeah, I mean to a certain extent how this black box works. On the telco versus banks, one of the key questions, I think it was raised here, is the ownership of the customer. Is it my customer, the bank, or is it the telco operator customer? And you cannot imagine the endless discussions until people turn blue in the face, yeah, about the right. Well, that's one very strong point, and the two players have to come to a gentleman's agreement that the telco company is there to exploit the potential on the telco side, while the credit institution is there to exploit the potential on that side of things. They have to understand their roles. They have very specific roles to play. They're not carved in stone, but there are some very strong components to them. Only in most markets I've worked in, only bankers are allowed to carry outstandings. A telco company isn't, unless the telco company goes through the hula hoops of creating a banking institution or a financial institution. But even if they go to that extent, chances are they will have difficulties managing that banking institution, that finance institutions, because they're just not, they've never come to grips with the very strong regulatory elements. So I think the success is really getting the two parties to work together. It's hard work. I've been there. I've been in the middle of the table trying to get the two guys to agree or to disagree, but to understand why they disagree. It's a long process. It's about being very crystal clear about the business model, about expectations when it comes to margins, etc., etc. But this is the key. In our world today, the way it is structured, the way it is regulated, digital finance or mobile-based finance can only emerge as a result of a cooperation between a telco company and a banker. If we manage to get them to work together, then you have a chance, a fighting chance, of having a successful operation.
Another round of questions. Yes, please. Yeah, why don't you come up to the queue, and this maybe have to be the last round of questions before we call it time. So, please.
Quick one, quick two from Gerard Coutier from CGAP. Firstly, Paul, you must help me here. If the institutions, the financial institutions, are looking at big data to understand customers and to push more things to customers, what do they do really to get customers to understand what big data can mean for them? Because I would argue that the model in the market is predatory rather than supportive. So if just your reaction to that. And then on the partnerships, Jamal, we've seen Equity applying for an M&O license, and we've seen First National Bank in South Africa applying for an M&O license. When will the M&O start applying for banking license? Because that will be no partnership needed. We own all.
Already happened in Pakistan.
Hi there, my name is Alban Pruthi. I'm with Financial Infrastructure Group with Global Practice Finance and Markets. So my question is, I'm very interested in terms of, how do we set our expectations when it comes to the big data and how that will help in terms of the financial inclusion? We have a very aspiring and, noble challenge, which is by 2020, we need to achieve universal access to finance by Dr. Kim. So, I was just curious, from various sort of points of view. And second question is basically, we see different trends in terms of developing versus developed countries. So I would be curious to learn what could developed countries learn from developing countries and vice versa in terms of, how this utilization of big data and financial inclusion could go. Thank you.
Hi, Ross Grady from the World Bank. Two quick questions. First of all, on the provision of credit, reliance on digital data and through mobile phones. What do the NPLs look like for that sort of credit? And are they different from credit provided through more traditional means? Second question, more generally, or comment plus question on privacy. We're talking about ownership of data, and I think, Jamal, you picked on this a little bit, but should we be more talking about who has a right to use that data, who has a right to disclose that data? I mean, do we really care, to be honest, who owns it? But who has a right to control its use and disclosure? And finally, a quick question on privacy. It's standard throughout the world, if your application is rejected because of a credit report from a credit bureau, you mentioned this, Jamal, you've got a right to know so I can go and correct that report if I think that it's wrong. But how does it work if your application is rejected because of what I do on Facebook and who I interact with on Facebook? I mean, how's it going to work in practice? This is, I think, a hard question. I don't know.
Quick prediction, half the room will go defriend their high school friends after this call. So, quick prediction.
Hi, Dan Salazar, Product Development at MasterCard. Jamal, you mentioned some interesting things about new data. Some of the interesting things being done around supply chain and merchants, acceptance, and I'm just curious your thoughts about the supply chain, leveraging those data elements and the value to merchants when you're working with them to garner their acceptance to capture this type of data.
So we've got a series of questions, and I'm going to ask each of the panelists maybe to address the ones that they think they can, and I'll try and pick up what was left out. This will be the last chance, I think, to say something among the panelists. So we've got a series of, I think, very good questions. I don't know who wants to go first here. Put your hand up.
I'm actually happy to defer to our guests.
I don't have good answers, but can respond anyway. Gerhard, I totally agree. I do think that data can be used for good and it can be used for bad. Products can be good, products can be bad. I think that what we see today is, like I mentioned before, data currently is enabling access far, far more than it is disabling access. And I think that is, for now, given the business climate, the overarching business case for using this data is to say yes to more people. Think about it. It costs money to acquire all these customers. If you have 100 customers enter the top of the funnel and you reject 90 of them and you only lend to 10 to them, you're not making use of your customer acquisition activities in the same way as if you can say yes to 30 or 40 and maintain the same risk level. And so I think that's what people get excited about. Now your question is, are they accessing bad products? Are they, I think, and I come back to whoever said this first, but all of financial services is like medicine. You need to take the right medicine in the right dosage at the right time. And I think we start normally with the belief that customers normally, not always, know what's best for them. We can come up with many, many exceptions to that rule, but in general, I like to start with if this customer's seeking this product and they know what the terms are, I want to start with they probably know what's best for them. God knows, I worked in Indian microfinance from 2006 to 2010. I know there are exceptions, experience those exceptions firsthand. So I wouldn't take a stance strongly on whether all these products are good or bad. I do think that we're seeing big data applied in contexts of short-term, very high interest rate, small dollar loans, and that scares me as much as I think it probably scares a lot of people in this room. Some of these interest rates don't seem defensible. We've looked at institutions that are doing 3, 4, 5,000% interest. At the same time, I don't believe that interest rate levels are the end of the story. When we think about whether a taxi cab ride is reasonable or not, we don't think about taking that taxi cab cross-country. You're using the taxi cab to get from point A to point B and short and quick, and you just need it then. Similarly, a hotel room. If we thought about living in a hotel room for a year, that'd be really expensive. So when we apply the APR approach to products, I don't think we're getting a complete picture. When we look at products, I mean, we're an impact investor. We are a nonprofit investing in for-profits. We're really looking through how does this interest rate compare to what they're using it for, to their alternatives, to how well informed they are. I don't know if we always make the right decisions, but that's, I think, how we approach it. So I have a lot of concerns as well, and I do think that we're going to have to monitor that more closely. Really quickly on the merchant point, I think it might have been me that said that because we are invested in, to your left, Amrit was at Kopo Kopo. They acquire merchants and manage their M-Pesa transactions and make it easier for them to accept customer transactions or customer payments via M-Pesa. But then, like any merchant cash advance business model around the world, can then turn around and use that data to extend credit. And so I think that's one example where the merchant, I think is pretty thrilled to say, oh, okay, you're going to give me a new offer. You already have this data. That's great. Similarly with purchasing retailer and distributor chains, there's a lot of valuable data there. One of the things that's most predictive is how long has this merchant or retailer or whoever been in business? What is their monthly volume? How consistent has that been? Those are metrics that are really closely aligned to ability to pay. Don't get into willingness to pay at all, but they are aligned with cash flows and things like that. So I do think there's some value there. Still early, and we're still figuring out how to best access that data, make it reliable, credible, things like that.
So sorry, I went back on my pledge. I just have one sentence I want to add on this issue of high-priced consumer loans. To me, the question is not the price, it's the fact that it's a push loan. And the head of Wonga, which is a rather notorious UK payday lender, said, we can't make people take loans they don't need. Of course you can. And the behavioral aspect of this is quite important to understand. Receiving an instant loan privately that you didn't necessarily even ask for. We don't understand how that works for consumers.
First question I've heard or comment I've made is about the ownership of data. It's not the ownership but the use you make of the data that I think we have better chance of being in a position to regulate efficiently. Ultimately, my personal perspective is that the data belongs to the consumer. Yeah? Now, the consumer owns his data, but that data can be put to use for the benefit of the consumer, the financial institution or whomever, provided we get into some sort of enlightened consent. So it is the usage of the data, the price that needs to be paid for using that data that should drive this discussion as opposed to the ownership, because again, as far as I'm concerned, the ownership is with the consumer. I heard the comment, I think coming from South Africa, where we have possibly telco companies creating banking arms or and vice versa. Well, let me tell you, having worked with big, large international companies, it's not because you're under the same roof that you're friends. Yeah? It's not because you're part of the same company that you're really going to understand each other just like that. And I'm curious to see how those executives on either side are going to understand each other. It could be a solution. Let's take a look. Let's watch. I think South Africa has always been a very creative market. In fact, the very first scoring system 25 years ago that I developed was for ABSA in South Africa. So, yeah. That was one of the very first few big international user of scores, of scoring systems. NPLs tend to vary, but one figure that I can share with you is that will give you a clue as to the impact of those black boxes. I mean, those black boxes have an effect. I was lucky in the sense that I helped FICO develop the scoring activity in Europe, yeah, and we implemented first-time scoring systems in a large number of institutions, starting with UK banks. And the figures we've seen there, I'm not talking about non-NPLs because it can vary, but let's talk about bad debt. We've seen reduction of bad debts ranging from 20 to 50% with the introduction of scoring system without harming the business. When if you close the faucet and you don't grant credit anymore, you'll get bad debt of 0. No, we're talking about bad debt at same acceptance level as before. Supply chain. I mean, I'm a strong believer that credit facilities embedded in the supply chain in the emerging markets will be more efficient. Why is that? I mean, in many of those emerging markets, you have on the one hand sales activity and on the other hand credit that's supplied by microfinance institutions. Microfinance institutions that charge very, very high interest rates in many instances, and rightly so. I mean, they have their costs, they have their bad debt, they have their operating costs, etc. But more importantly, their credit products they're putting on the market do not map with. I'm sorry, it's getting very acrobatic here. Trying to. They do not map the actual goods that are. When a farmer purchases seeds, the revenue from those seeds is going to materialize 6 months down the road. The credit company is going to come knocking next door seeking its first repayment. So what you need is a lot more coordination between credit, and you achieve that by integrating the credit. That we've helped numbers of franchises to develop their credit activities because they were not completely happy with the credit facilities or the type of partnerships they had set up with microfinance institutions. And I think I've covered most of the questions that have been addressed.
Thanks. I'm going to take the privilege of being the moderator just to make a few final wrap-up comments and to say thanks. But there was the question here about setting expectations around digital data and what it might do for universal financial access. I think we would probably suggest, at least from CGAP's side, probably what's going to be a bigger driver early on is probably less the data. It's probably more technology and being able to put accounts and agents much closer to the end consumer. In time, that might begin to generate more data that allows us to have insights for the end clients. But there's probably, in terms of getting to the large numbers that President Kim at the World Bank has laid out, it's probably technology and agents that would drive that at the front end. Roz, in terms of some of your questions, I'm not sure we answered them all, but I suspect that in most of the markets where some of these crazy uses of new data are being used, that the rules around the right to know, the right to use, some of the privacy rules are not in place today. And I would be fairly certain. I would say I've just come from a country yesterday where there is a rule in the banking sector: you cannot lend without 100% security as well. So there are many rules in many countries that reduce credit to the elite 5% of the country. And so I ask, in that environment, how concerned should we be with getting the exact rules in place before we begin to provide wider sets of access beyond the elite? I would further make the cautionary statement: most banks that I'm familiar with in low-income markets really only serve the elite. They largely exclude the population that I know the people in this room really care about. And so I think there are many of the risks that we need to begin to be able to deal with so that we can begin to leverage the opportunities that digital data puts in front of us. And I think the panelists have done a fantastic job of really laying out a whole series of questions that we need to begin to ask as we embark down the road to think about what the potential is and how we harness this and how we don't unleash something that would be ultimately counterproductive to what I know is the goals that everybody in this room share. So thanks a lot to Paul, Jamal, Kate, and to the organizers at the back. Thanks very much.
We're a bit behind schedule. We said we would end at 12:30, so if any of you need to leave at 12:30, please, we won't judge you for that, but we will continue for an hour and a half until 1 o'clock. So we spent the morning, I should introduce myself first. Sorry, my name is Claudia McKay, and I work with CGAP based in Nairobi. And I work on digital financial services across a number of countries in Africa. And this morning we spent a lot of time setting the scene, looking at the really big picture, high level of what is digital credit, what is big data, how can this be applied, especially to financial inclusion in poor and unbanked sectors. We've already mentioned M-Shwari a number of times, but the panelists were very kind to hold off delving too deeply in it, knowing that this panel we're really going to go in depth and really try to unpack this product that you've heard about and may know a bit about, and try to figure out what it really is and how it's being used and why we think it's so important. So M-Shwari is a product that has brought millions of poor, previously unbanked people the full benefits of a banking product, including interest rate on their savings, deposit insurance on their savings, and of course access to credit. That's what we're focusing on today, but using mobile money as a gateway. And so I think that it's really the first demonstration at scale of a lot of the concepts that those of us in financial inclusion have been talking about and hoping for and wanting to see happen. This is one of the first examples where we can actually say that, yes, this is happening and at scale. So this morning for the presentation, I'm really excited to have two experts with me. One of them will talk more on the banking side, Commercial Bank of Africa, who developed the M-Shwari product. And the other one will help us understand the customer side. So first, Peace Osenyer, who's the financial risk manager for new business ventures at Commercial Bank of Africa, will speak to us. And I should mention, we were just chatting that today is a public holiday in Kenya, so thank you very much for not only traveling all this way, but also speaking at our event on a holiday. And Peace really spearheaded the credit decision model for M-Shwari in Kenya, as well as the credit decision model for a similar product called Empower in Tanzania that CBA launched about a year ago. Is that right? So she'll be speaking to us about the basics of M-Shwari, what it is and how it works. And then Julie Zolman is the principal investigator of the Kenya Financial Diaries. And so these diaries, if you haven't heard of them, tracked all financial transactions over the course of 1 year for 300 low-income households in Kenya. So there's a wealth of insights that have come out of that. If any of you have not read that report yet, but you're interested in understanding customers and financial inclusion, highly, highly recommend that you read that. And Julie will share a few of the insights this morning, and especially how some of the insights she has on customers and their need for liquidity, which will relate to M-Shwari and why it's become so popular. And then I'll come back up and try to bring those two sides together and really focus on the product itself and why it seems to be meeting the needs of customers in Kenya and their need for credit. And then we should have a good amount of time for discussion and questions and answers. So that's kind of the format of this session. All right, so I think that all of us have a pretty good understanding of Kenya and the context and the success story of M-Pesa, which is really the foundation upon which M-Shwari was built. But in case some of you have been in a cave or on a different planet for the last few years, Kenya's predominant mobile money service is called M-Pesa. It was launched in 2007 by the mobile network operator Safaricom. And at that time, and still today, but especially at that time, they had over 80% market share. And today, 7 out of 10 Kenyans are active mobile money users, so having used mobile money in the past 90 days. And 8 out of 10 live within 5 kilometers of a financial access point, with the majority of these being M-Pesa agents. So if any of you have been to Nairobi, I think you'll agree with me that the agent network is pretty ubiquitous, and anywhere you go in the city, you'll find multiple M-Pesa agents where you can transact. So that's really important to kind of understand this as the foundation for how M-Shwari was able to grow so quickly. So in 2012, November 2012, enter M-Shwari, which is a savings and loan bank account that is exclusively accessed through M-Pesa. So at that time, CBA was relatively smallish bank, not a huge branch footprint, not a household name for most mass market customers. But they teamed up with the giant Safaricom, which is one of the, I think it's actually the #1 brand in Kenya, I saw on some reports, to launch this product called M-Shwari. And it can only be accessed through M-Pesa, but as I said, it is a bank account offering both savings and loans. So at this point, I'm actually going to just hand over to Peace, and she's going to tell us a lot more about the basics of the product and terms and conditions and how it's being developed. Thanks.
All right, good morning, everyone. Good morning. All right, I'm just making sure there are people in the room. As Claudia mentioned, my name is Pisa Sanger, and I work for Commercial Bank of Africa and in financial risk management. This morning, I will speak about M-Shwari, which is a mobile-based micro savings and credit product that was launched in 2012 between Commercial Bank of Africa and Safaricom Limited. CBA, for anybody who knows anything about it, mainly has focused on the upper end of the customer from an income perspective, and has in recent years changed its strategic objective to really begin to focus on the financially excluded customers. And that is one of the initiatives that really drove CBA to partner with Safaricom and offer a product that will really deepen financial inclusion. How really does, I've actually covered this slide already. What really is an M-Shwari product? As I've mentioned, 1, it offers a micro savings, and 2, a micro credit product. As Claudia has mentioned, it's embedded within the M-Pesa SIM toolkit menu, and a customer is able to open an account instantly. All you need is a mobile device. It doesn't matter whether it's a smartphone or a feature phone, you are still able to open an M-Shwari account. What a customer has to do is go to the M-Pesa menu, select M-Shwari, and activate. And at that point, they're requested to accept the terms and conditions. When we looked at the M-Shwari savings product, what really is it in it for the customer? 1, with the savings product, the customer is able to earn interest of between 2% to 5%. There is no minimum deposit requirement at the time of activation. As long as you've activated the account, you can wait until you're able to get a little amount of shillings or money and deposit into your M-Shwari account. Okay? There are no charges associated with transferring money in and out of a customer's account, in which case, if a customer deposits $1 into the M-Shwari account, they'll be able to get $1 out, so there's no value erosion. As Claudia mentioned, an M-Shwari account is considered like any other bank account, and the deposits are insured. So in case of any potential eventualities, the customer deposits are insured up to about $1,100. In terms of account activation, what I failed to mention is once a customer activates the account, we are also able to electronically verify their KYC information. So basically, we have the registration details that the customers use at the time of activating M-Shwari, which is electronically verified against the Kenya government population registration database, and within 8 seconds, the customer's account is opened. So that's how we can quickly turn a financially excluded person into someone that can access financial services within 8 seconds. The other interesting thing about the product that we offer is the credit aspect. The credit product, the process at the moment is on account activation, we do a KYC verification on your account. Within 8 seconds, the account is opened. Once that process is completed, we initiate an immediate credit scoring in the back end that the customer does not even realize is happening. And in less than 30 seconds, the customer has a credit score and a credit limit. If they so choose, they can be able to borrow within 30 seconds of activations. Some of you may ask, is it too quickly to grant credit to a customer? What we've been able to do is leverage the telco data that we've mentioned in really trying to identify what aspects of a customer telco behavior can help us predict the probability of default. And this is the information that we then use to assign a customer a credit limit, which at the point of activation, they could choose to use or not use depending on their needs at the time. What really are the features of our credit product? It starts from as little as $1, and some people may say $1 is too little, it could be little if you're seated in this room, right? Because if you think about your cup of coffee, it's probably $4, $5, right? But for somebody in Kenya who's really struggling, 20 cents makes a difference. 20 cents could be the transportation they need to move from home to their place of work. And $1 to them could be what they need to make a difference in their life. And what we also try to avoid is when we give credit initially to a customer is to make sure we don't give them a significantly high amount that will cause them to break. We start them off very small, from between $1 to $30. And with time, we observe how they're able to service the amount of credit we've given them. If the customer is able to show indications that they're comfortable with their credit amount, they're finding utility in it, and could benefit from a high amount, then we slowly and gradually increase the customer to a point that we feel this is an optimal level above which they could potentially default. So we do try to do that, and that's why we see our loan amounts are relatively small in size. In terms of the facility fee, we don't call it interest, we call it facility fee because it's a one-time fee we levy on the customer. When you borrow respective amount, we charge a one-time facility fee of 7.5%, which is payable within 30 days. If the customer is unable to pay within the 30 days, we give them an option to roll over the loan for another 30 days at an additional fee of 7.5. It's important to note that if the customer is unable to pay within the 30-day rollover window, we do not assess additional fee. So we don't have this never-ending interest computation that could really make the financial burden for the customer. And that's why we talk about the non-compounding interest on late payments. Okay? The other aspect is the loans are generally unsecured, and the customer is not required to have any sort of funds in their account to be able to access this credit. So at the time where you're probably going to a hospital, you really need money to buy medication, you don't really have anything, you can go to M-Shwari, borrow, and be able to pay for your services. So that is what we talk about in terms of unsecured. As we continue to grow your limit, we also look at your savings profile. We want the customer to be able to understand there's a relationship between putting away that extra 10 cents, 50 cents, $1 to have a positive impact on your credit. So for customers who generally save on M-Shwari, we tend to grow their limits a little bit faster than customers who generally do not show some indications of savings. Okay? So at the very high level, that is really what our main savings and credit product is all about. In terms of at the bottom, what really is our promise to our customers? At CBA, what we try to do is provide a service that's convenient and accessible to all. By requiring customers to be able to, by making it possible for customers to activate their accounts electronically without having to fill any forms, without having to provide any form of physical identification, we are making it possible for that woman in the village who has a feature phone to be able to access financial services with limited burden. That's why we talk about making it convenient and accessible to our customers. We also make our products, if you are rejected for a loan, for instance, if you get a limit of 0, because not everybody who opts for M-Shwari gets a loan, it's silent. It's not somebody standing in a bank and you're sitting there and somebody tells you, sorry, I can't give you a loan. So there's a silent dismissal, and what most customers tend to do is they'll either call and say, what can I do to get a credit limit? And that's why we begin the whole aspect of financial education. We say, this is what you need to do. Start savings. If you want to get the credit limit, borrow, repay on time, really make sure you build your credit profile to grow your limit. So we take what could have been a potentially embarrassing thing for the customer and make it more of a very discreet denial process. What we also say is we trust you with our money before you give us your money. So you come in, you can put in as little as 10 cents or 1 penny, and we could potentially lend you $30. Right? So we say we trust you with our money before your money. And as we continue to work with you, we're able to recognize the change in character, what you're really exhibiting from a financial inclusion perspective and a financial behavior, and that's reflected in how your credit limit grows. As I previously mentioned, how really does it work at the point of account activation? As mentioned, it's instant and it's electronic in nature, both in terms of activation. The KYC verification is also electronic, and the credit scoring as well. What you're seeing here is just the user interface in terms of how customers interact with M-Shwari. Once they've activated the M-Shwari menu, which is here, the green circle, these are the range of services that customers can do. Can either deposit, withdraw, borrow, pay loan, check their loan limits. So pretty much a suite of services that they can get by walking into any bank account. But at this time, they can be able to do it at the convenience of their home. Okay. In terms of credit scoring, and I think this is where big data comes on board. Credit scoring has been one of the key enablers of us to grant instant credit. At the time of developing the M-Shwari scorecard, as Jamal mentioned, we grappled with what kind of data can we use to assess credit for somebody that we actually have not met. Okay, when you look at telco data and say, okay, what does someone's airtime usage tell me about them? What time of day they call, or how much money do they send? Does it really tell me anything about their credit worthiness? We ended up, we were stuck with millions and millions of records and customer data that we needed to figure out and make sense out of. Luckily, we were able to also tap into Jamal's 25 years of expertise and really to kind of work together and try and figure out what is the behavior of the Kenyan consumer. What type of airtime product do we have that could really give us a semblance of a customer's behavior with credit? And that's why one of the tools we leveraged was the airtime credit, where you can borrow emergency airtime credit as an indication of what a customer could behave if they're given us a banking product. When it comes to really making sense of the data, there's a lot of statistical analysis that had to go with it. And unfortunately, at the time of launching M-Shwari, we really underestimated the capability or the processing power in terms of computing that we'll need. And we had to do with a lot of Excel and Access. And if you know anything about it, if you use more than 1 million records, it really crashes on you. So that really became our challenge at the time, is how do we get all these millions and millions of records, make sense out of it, because you cannot use, 100 variables to make a decision on the customer. It's very impractical. How do we get these data sets that we have, narrow it down to a meaningful set of data, come up with a defined scorecard that can really give us some meaning and we can be able to explain. Okay, and above and beyond just relying on the statistical analysis, we had to apply our human intuition and understanding of the market. Okay, when we see some variables that, yes, they do make sense from a statistical perspective, but when you think about it, you say, can I really be able to explain to a customer why this variable makes sense? In instances where ourselves were questioning that this is a little bit sketchy, not really sketchy, but this does not quite make sense, we felt that's probably something we could exclude from the data. So we wanted to make sure that at the end of the day, the variables that we select to develop the scorecard, it's something that we can be able to derive meaning out of and be able to explain to a customer when they contact us and say, look, I want to be able to access credit. What can I do? We wanted to be in a position that we can be able to guide the customer, give them an indication of what type of behaviors they need to exhibit in order to be able to grow and improve in their credit history. When you look at the bottom, this is just a very high level in terms of the process that we had to follow, which was in terms of this large data set, which variables can we generate from it? What statistical analysis do we need to conduct to make sense out of the data? And how do we really narrow down the data to come up with the final scorecard? And above and beyond that, how do you deploy the scorecard into production? Because the tricky thing with dealing with a mass market is the minute you deploy the scorecard into production, every day we get about 10,000 applicants. So you're making instant decision on 10,000 people. And that could translate into a lot of dollars in a day. So by the time you realize 90 days down the road that, oops, what I deployed is not really working, there's a lot of money out of the door and a lot of explanation to the board of directors. So that tends to be my burden every time I have to either deploy a new scorecard or really evaluate how it's doing. And a lot of the time what we tend to do, with the exception of the initial scorecard, since we didn't really have a choice, is run a pilot on a small subpopulation, really get to study how that population performs before we really fully deploy a new scorecard. Okay. And in addition to just deploying a scorecard, what is also very critical is how we manage the portfolio. Because the scoring can be able to get you to a certain point, but how you manage the portfolio is what then gets you to the end result. What we've done is we've ensured that we continuously engage the customer through SMS notification throughout the lifetime of the loan. This is to avoid surprises and to help our customers respond. Okay. Some of them actually say we're reminding them too many times, but I think for us it's better for the customer to be aware than to be surprised at day 30 and then they have to pay a rollover fee and they forgot about it. So we make sure we continuously engage them throughout the lifetime of the loan. What we also do is we try to make our messaging as descriptive as possible. I know there was a mention of CRB listing, Credit Reference Bureau. It is very unfortunate that we had to list some customers. But for us, what's important is we've done our part in terms of educating the consumer throughout the journey, especially even before a customer is listed, which is about 100 days later from when they took the loan. We always tell them this is what it means to be listed. If you were listed, you'll be denied access by other lenders. If you're listed, you'll have to pay an additional 2,200 Kenya shillings to get a CRB clearance certificate. You will be blacklisted. So we really try our very level best to inform the customer what the consequences are. Above and beyond that, we also have call center, a collection center, where before we get to the point of listing, we really have exhausted all possible avenues of communicating with the customer. We've sent SMS notifications. We've called you. We normally call the customer just to say, okay, did you understand our message? This is what it means. What really can you do to remedy the situation and avoid getting into a CRB, getting listed. So by the time a customer gets to CRB listing, they clearly have either ignored or they've willingly accepted the fate. And we do hear this a lot of the times because they come to our offices, to get the clearance, and we ask them, did you get our message? They're like, yeah, I did, but I didn't think you were serious. So you want, and most of the time they're people that are fairly educated, that say that I didn't think you were serious, and some people will say it's $1. Like, really, what's the big deal? So for us, what we always have to remind the customers is $1 is only $1 if it's to one person. When you have 1 million people with dollars, then that's $1 million out of the door. So really putting it in perspective for the customer and trying to educate them as much as possible what it means to have a good financial credit. What we also do as part of a portfolio management process is really send periodic SMS notification in terms of what the customer can do to remedy or really improve their credit profile. We'll tell the customer this is how much you need to save, how long you need to save. We'll try to promote retention as opposed to deposits. Because with customers, our customers will always try and guess how the credit scoring works. And that becomes the danger of really explaining to the customer, okay, this is what we look for, because they'll try to game it. So you'll have a customer who deposits money in, out, and they call him and be like, yeah, I've been saving. How come my limit has not grown? I said, you've not really been saving, you've been depositing and withdrawing. So really giving that distinction to the customer that there is a difference between really putting money there, let it work for you, and by the time you have an emergency, you can be able to complement both your savings and your credit to really sort you out in your time of need. All the measures we've taken so far have favorably reflected in our portfolio. At the moment, we have an NPL rate of about 2%. Which is about 300 basis points better than the industry average in Kenya, which is around 5%. Our executives will want that number to even go down to 1% or 0 if possible. But, we try to remind them that, at the end of the day, we're dealing with, customers we don't really get to see, people that we have to really connect with through a mobile device. And, a really wide population that in the past have been unbanked or underbanked. So for us, that has been really key in terms of how do we continue to educate our customers to really be good credit risk. Because at the end of the day, we never take pride in listing a customer. And that's why we put all these measures in place to make sure that they don't get to that point. And secondly, we want to make sure that the M-Shwari portfolio quality continues to remain sound if it's to make business sense and if we are to continue servicing our clients. In a nutshell, what really has been the impact of M-Shwari and how really has it grown over the years? So this chart just shows the progression in terms of customer enrollment. As I've said, since launch, we've averaged around 8 to 10,000 customers registering a day. And I always joke with my colleagues, I'm like, where do these people come from? I thought by now we'd have exhausted all the enrollments. But it clearly shows there's still demand in the market for financial services that are easily accessible. With M-Shwari, our customers have been able to deposit close to $1.8 billion and borrowed close to $339 million in loans. Actually, a greater percentage of our population, about 67%, are young people under the age of 35, and women account for about 39%. I put these numbers up not because I want to show, okay, this is how great M-Shwari is, but to just indicate what impact it's had in the community. When we talk about 10.2 million customers who've signed up for the product, that's 10.2 million customers that now have a digital footprint. We have a customer who is able to call us and say, look, where can I get my M-Shwari financial statement to go to the bank and borrow a bigger loan? This is a customer who previously had money, could have been the agriculture person that Jamal was talking about, who his transactions were previously invisible. We've been able to create a digital footprint for this customer. The $339 million in amount disbursed for me represents the woman who is at a clinic and trying to get medical care and has no money, and M-Shwari is able to come through for them. The 39% reminds me of women who previously felt helpless and could not open their own bank account, but now can discreetly have an account or a rainy day fund if and when it becomes needed. 67% of young people for me represents the college student who said, the one thing I love about M-Shwari is I can deposit 20 shillings or 20 cents into my account. I can begin to save and I can begin to, learn how to manage my financial products. And for me, I think those are my key takeaways. When you have a casual laborer who's able to say, M-Shwari has come through for me, a mother who's able to say, I was able to pay my medical bills because of M-Shwari, and a shopkeeper who's able to say, I was able to finance my working capital because of M-Shwari. It could be $1, it could be $10, it could be $30, but from where I'm seated, as long as it makes an impact in someone's life, I think for us, we've made a difference. And I think that's what, for me, has been the M-Shwari story. And I hope it's made sense for everybody in the room. And the key thing that we always look for, especially in our Twitter accounts, is when customers says, there's a common phrase that people like using in Kenya, M-Shwari imeni sort. Okay? Which means M-Shwari has sorted me out in my time of need. And that is what makes us happy every day. Thank you very much.
So I'm going to talk a little bit about why I think M-Shwari is such an attractive product in the Kenyan marketplace. And for those of you who haven't been to Kenya, I want to assure you that there are many, many products, even ones launched by Safaricom, that have not been runaway successes. And so I think there's something that's really special about what M-Shwari is offering that's very attractive to the low-income market in Kenya. I'm going to be drawing on, as Claudia said, a study that we did from 2012 to 13 of 300 low-income families across Kenya. And what we did was to try to visit them every 2 weeks and to track every shilling coming into the household, every shilling going out, and everything that happened in the meantime with that money, including what was going on in people's lives at those moments when they were making different kinds of financial decisions. So a really, really rich data set. The other advantage that we had was we were lucky enough to be watching this market during the time that M-Shwari was launched. So we were able to see some people trying it out for the very first time in our market. So of the 300 families that we were watching, probably about 600 individuals, we had 32 users in the time we were watching, which was very early on in M-Shwari. So the first thing that I would point out about this market is that the majority of Kenyans are poor, and we sometimes forget that poverty means not just that you have very little money, but you actually don't have enough money to meet your basic needs. And when we're thinking about financial products that we think offer absolute value, what we often forget is that they also have differences in value amongst themselves. People cannot put their money in all of the financial devices that are available, and they have to make choices. So if you imagine a household that's getting about $100 a month, and that's above our average, the median household in our study was making about $80 a month. When we look at the median expenditures that were going to things like very basics, food, housing, the absolute essential piece of school fees that you have to pay in a given month to keep your child in school, we found that about 70% of that income was gone immediately, just the very, very basics. And then there were all these other things that people wanted to do with their money. They want to send some money home to their father for his upkeep, which is actually quite an obligation. You might want to clear the balance on those school fees so the child doesn't get sent home again next month. You may think health insurance is a great idea, so you would like to be able to pay premiums. You might want to buy stock for your business to keep your income coming in, buy some improved feeds for your cow, lots of things. And oh yeah, put some money aside to save. But what we saw was that people were not making trade-offs between good choices and bad choices. They're making trade-offs among all of these good choices. So if they wanted to do all of these things, they would need another $70, but they have only about 30, and they have to allocate amongst those things. So people are living pretty close to the edge, and they don't have enough money to do everything. We also found that people's incomes were very volatile. So the median household in our study, their income fluctuated 54% from month to month. That's a huge variation. So if you have this hypothetical average income of $100, that means some months you're getting $150, and that's great, and you have some excess to play with. You can maybe do some big projects. In a bad month, you have 50. And remember, your needs are around 70. So how do you get there? What do you do in those months? And you never know which one is coming up, a good month or a bad month. When we saw how people were making their financial choices, we saw that among those options of what to do with that extra money when you have it were decisions between keeping money on hand to stretch your budget or cultivating social networks and credit offerings from different kinds of shops and the schools so you could stretch that extra budget. You could make that 50 into the 70 in the months that you needed it. And your obligation to invest. In a market like Kenya, you don't get employed out of poverty. You build your own way up by investing in your productivity, whether that's investing in your children's school fees, in your farm, and especially in your business. And people recognize that. The trouble is that investments are risky. And so what we saw was that the main way that people were investing was through savings and not through borrowing. And you can see that that's quite a wise choice for them. But to do that, they would take their savings and put it in illiquid forms so that they could build it up into something that was a meaningful chunk for investing, about a month's worth of income at a time. So very, very little savings was here to stretch. That's where credit was very helpful, and the help of the social network. So just an interesting thing that we've recently looked at is that 80% of our households were accessing credit from shops, schools, and clinics. So very informal, and we hardly even see that showing up. So we're not talking necessarily about money lenders here, we're talking about social forms of lending. And most of those cannot make a credit decision in 8 seconds. So what people told us is that when you're in this kind of situation where there are so many imperatives on your money, and your money has to do so many things for you, and your money really is essential to be growing, that to just put money aside on your M-Pesa account, you saw the savings levels in M-Shwari around $6, that's pretty small. Just to keep money stagnant, to have it sitting there feels incredibly wasteful. That money should be doing something. They told us that money should be working. And working sometimes means being spent, because there are always needs that are unmet. And sometimes it means helping your neighbor and making sure that the neighbor is able to use that money right away. But the concept of it just sitting there just in case doesn't seem to fit. So we just didn't see a lot of people keeping a lot of cash on hand for emergencies. What they did keep on hand was, on average, about $6. About 10% of their savings would be in a liquid form where they could use it for that stretching function. But there was a lot of other money out there and being mediated in lots of different ways. The typical household in our study was using 14 different kinds of financial devices. I should say 14 different devices, some multiples of the same kinds of things. And this is an example of one of those respondents, Patrick. And Patrick makes charcoal stoves in Nairobi. And he is trying to put 3 sons through secondary school, and he has several other children coming up through primary school, or they're going to be entering secondary school soon. This is an enormous expense. So he needs to cater for those huge school fees, a big investment, his business. He needs to send money back to his wife regularly for the upkeep of her and the children that are back at home, and just smooth the fluctuations of 54% per month in his income variability. So you see he's got lots of tools here that are helping him do all these different financial jobs. And I've lined up his list of devices by the percent of his income that is flowing through them and his assets and liabilities. So here you see that 35% of his income over the year was going in and out of M-Pesa. So he was using that really, really intensively. But he wasn't making a choice between M-Pesa and a bank. He was using both. They're doing different jobs. M-Pesa for him is to send money to his wife. His various kinds of savings groups, we call them chamas in Kenya, are there to help him build up money for school fees. So actually when we plot out his financial net worth over the course of a year, we see him build up, and then go way into the negative as soon as school fees are due, and spend the rest of the year trying to climb back out and build up for next year. So he's doing lots of stretching, but on aggregate, he's really trying to build up and accomplish this annual cycle of investment needs. His current account is a place that he goes to park money because it's safe. He hardly ever uses it, but he keeps a really large balance there relative to everywhere else. That's a little bit unique. We don't see a lot of money just parked. His shop credit, he used only 11 times in the study, and he used it for such small, tiny, tiny values, those dollar kinds of borrowings that we think are so unimportant. But he thinks this is a really important product. When we asked him about his most important financial products, this one came up because it's the possibility of borrowing that's important to him, not necessarily how much it's being given. It's that the shop sorts him out as well. So lots of different tools doing lots of different jobs for people. In all of this context, we also recognize that people face a huge range of risks. They don't face just one kind of risk that stands out. What you see here is the incidence and severity of risks that people experience over a 5-year period. So we did a module on top of what we were already doing to say, okay, we saw 1 year, but we don't know if this 1 year reflects reality. So let's look back 5 years and see how it lines up. And actually, we had a very similar picture, except for things like drought, which affect people in different kinds of intervals. But you see that outpatient medical treatment is far on this side, very, very common, not very expensive. On this side, the death of the main income earner, not very frequent, but extremely devastating, although the social networks do a pretty good job of filling in, at least in the immediate costs that come with those kinds of risks. But in this box, you see that there are quite a lot of risks that are moderate severity in terms of relative to people's income and moderate frequency. When we calculate the annual burden, so if we were to annualize the expected costs of the risks in that box, it would be about 7,500 shillings, which is an entire month of income just for risk mitigation. So people cannot afford to individually insure against all of these risks. They can't afford specialized insurance for each of these. They need more flexible types of risk mitigation that cover a bigger range of things, because you don't know in which year which events are going to hit you, but they're probably going to be more than one per year. So how do people get through these risky moments? When we plotted out how people were coping with different kinds of shocks, two areas really stood out. And what you're seeing here is on the left-hand side, the list of different kinds of risks that people face, and on the bottom, the different strategies they use to cope with them. And savings in the house is a really important one. So the first place that people tend to turn when something bad happens is that little bit of money that's on hand. Why? Because it's very accessible. But we also know it's very, very tiny. So it's only going to get you that $6 of stretch. What happens when you need more? Well, because the credit markets are not very well developed, and because social networks are very well developed and very capable and mostly redistributive. So new money coming in from the people in your network who are slightly better off to the people who are going through a hard time and tend to be worse off. So huge amounts of money are capable of being generated from the social network to help people deal with different things. So we have people that are hospitalized and family members, usually very few family members sending a lot of money to help people get through these moments. So very, very helpful, but incomplete. So when we looked at, we also measured the frequency that people needed medical care and went without, or the frequency that children were sent home from school for non-payment of fees. And they're very common. So 38% of our households needed medical care and had to delay or forego that because they couldn't come up with the money. Social networks don't always come through in time, especially for needs like medical care. While they're very, very good at financing things like funerals, social networks don't cover everyone equally. Women benefit much more than men, and rural households benefit much more than urban households. So there are a lot of gaps here. Not to mention that they also shift burdens up the chain. And the reality is that you may be a giver, but you're really only slightly better off than the receivers. So you're shifting burdens around. And we have lots of risks that are in the range where you could probably finance it yourself if you had a little time to work it out. So what we see, for example, in financing for health is that there are some sweet spots of financing for different kinds of mechanisms. So if your need is really, really low, down here, savings in the house can work out pretty well. You probably only need a little bit of money. What we saw was that people would have maybe $5 on hand, and they would go to the doctor, and they would be given a prescription for a medication that costs $2 more. They're already out of money. And yet that $2 may not be enough to jump into the next bucket of the social network. So they just wait, maybe with malaria, for 2 more weeks until they can fund that. So what I'm seeing here is that people do have a lot of financing options, but they're all incomplete, and typically you need to put together a number of them at one moment to make it all work, especially in these kinds of surprise moment kinds of events. So what M-Shwari seems to offer here, and that our respondents were really, really excited about, was on-demand liquidity. I can do more stretching in my budget, which is something that I need pretty often, several times a year. I don't need a lot of money, but I need something that fills the gap between what I can finance from my immediate liquid savings without having to tap all the money that I'm trying to keep aside for investing, and without necessarily having to go to my social network or complementing that social network piece for these kinds of small risks that come up all the time and the income that falls 50% short from month to month. Just one example of what this would look like. So here we have a family, Morris and Lydia, and they have a brewing business in Western Kenya. And their business is actually doing pretty well. In fact, they feel like even though they're making about 5,000 shillings a month, so that's about $55, $60, they actually worry that people in the community think that they're like uppity and that they're really doing too well for themselves. And they had a really exciting year during the diaries because they had been raising cows. Morris had been raising cows, and this is kind of an unusual strategy. Actually, very few of our respondents were raising cattle for sale. And he had sold one of these cows for a handsome profit just before the study for about $300. And he used that and some extra money from working and paying off over time to install electricity in their home. Installing electricity cost them about 10 months worth of income. This was a huge investment for them, and it was a formal connection. So you see here that this is when they installed their electricity. Their other big cost for the year was the school fees for their kids, and they have one daughter who is in her second year of secondary school, so that's a really huge expense. So most of the time, they try to match their school fees payments when they have pretty strong income streams. So you can see these red bars are when they're making school fees payments. And yet, several times throughout the course of the year, the kids get sent home. And this is a signaling device from the school, which is providing credit, basically, for the parents to be able to pay over time, that now it's really time to pay. And most of the time, they come up with that money very quickly. So they tap their savings, they go to those people they can borrow from, they stretch to make those payments. But towards the end of the year, the very last bar that you see, their oldest daughter, who was in secondary school, was sent home. She had a balance of 5,000 shillings, about $55, and exams were coming up. So the term was ending, the school year was ending, and she was short 5,000 shillings. And they were like, she's not sitting for exams until you pay. So Morris went around looking for money, which is a very common word as well in Kenya, common phrase. And he came up with 3,000 shillings. And he went back and said, can she come back now? Here's 3,000. And they said, no. School year's ending. So we were closing the study at this time. She had been home for 2 weeks before exams. And if she didn't get the money in time, she wouldn't have taken exams, and she would repeat the entire year. And the family would repeat the entire investment in that year of her studies. And this is not an uncommon thing. He needs 2,000 shillings. They were able to come up with 50,000 to install electricity. So you can imagine this is not an insurmountable hurdle, but this money is not on hand. And a product like M-Shwari can help people make sure that that doesn't happen. So just to conclude, I want to point out that there are a few other things about M-Shwari that I think really make it click in the Kenyan market that have nothing to do with the consumer value proposition, which is obviously very compelling. I want to point out that it's not all credit that people need. It's this very specific small-scale credit that seems like it's a real gap in people's portfolios. So people would actually prefer not to borrow $300 and start a business or grow a business. That seems way too scary, and they would much prefer to finance investments with savings. And they're doing that. So let's let them do that with small bits of credit. So M-Shwari is the right size for this market. It's not any provider. This is Safaricom, which has won people's trust over time by the consistent pricing and experiential learning that they've been offered through M-Pesa. So the fact that people could get immediate feedback and they knew and they expected that because it was Safaricom, I think was also very, very powerful. This is an eager market where our respondents were ready to test anything. They have seen M-Pesa and they now have faith that financial products can be very helpful. So we see people try out pretty much everything, even really terrible things like pyramid schemes that come around, because they're an expectant market and they have reason to believe that things are going to come that are helpful. And there was also something, and maybe Peace can talk about this a bit, whether she picked this up at all. There was a special moment politically in Kenya. This was an election year when M-Shwari was rolling out. And historically, banks have been connected to specific political leadership. And so our respondents, especially in Nairobi, were saying that when the new president took office, that because he's a shareholder in CBA, there's much reason to believe that the bank will be solid. And there were some fears that other banks that may have been favored by previous political leadership were going to be starting to disintegrate because they no longer held political favor. So when people started coming around promoting the product, people were very eager, perhaps more eager, and encouraged. Not just Safaricom was behind this, but also Uhuru Kenyatta's bank. So there were some special moments that all sort of the stars aligned, not just the consumer value proposition, but the way it was delivered, who was offering it, and how it was being offered. Claudia?
Great, thank you. Fascinating. I learned a lot. So I am now going to spend a couple of minutes just wrapping this together and kind of bringing together the two sides of what the M-Shwari product is and how it meets the needs of customers. I did want to say that we've just released a paper all about M-Shwari with a lot more detail than we can cover this morning. So there might be a few copies left outside. If not, download it from our website. But in order to do that research, we really draw it on three different sources. And so one was, of course, the diaries. Another one was the Financial Inclusion Insight Survey, which is a nationally representative survey in Kenya, which also did a phone survey specifically from M-Shwari users. And then finally, CGAP ourselves, we did a small number but a very in-depth interviews of M-Shwari users in an urban and in a rural area in Kenya. So that's where some of this is coming from. So I wanted to just start, because everyone's always asking us, Peace alluded to this, but just a little bit on the demographics of who are the M-Shwari users. In the blue bars represent the users in 2013, so soon after the launch. I'll get to 2014 on the next slide. And as you can see, compared to the general Kenya population, M-Shwari users, especially at the beginning, were slightly more likely to be male, slightly more likely to be younger, under 35, but significantly more likely to live in urban areas, to be above the poverty line, and to already have bank accounts aside from M-Shwari. If you look at 2013, and now we look 1 year later, especially at the last three categories where there were bigger gaps between the general Kenya population and the M-Shwari users, all of these are kind of trending in the right direction if we think that this is a product that we want to be accessible by the mass market. So the percentage of urban users went down significantly, so many more rural users. The percent that lived above the poverty line and who already had bank accounts also declining. So interestingly, this is very, very similar to what we saw for M-Pesa in general. So the early adopters did tend to be not the poorest. They were the more urban, kind of tech-savvy, a little bit more educated. But very quickly, we saw the poorer customers, the more rural customers kind of catch up. And now, if you look at any of the stats for M-Pesa, it's pretty much representative of the mass market in Kenya. All right, so one of the things that I saw on Peace's slide, I think the average loan size is about $15, is that right? So we've talked about the small amounts, but $15, the loan term is about 30 days. So these are very short-term, small loan sizes. Julie started to allude to this, but really, how is this so popular? How can such a small amount, such a small loan term really meet the needs of people? So our sentence to try to summarize this is that M-Shwari offers easy access to small amounts of liquidity in a way that fits how low-income people think about their finances. So I'm going to unpack this a little bit. So in our interviews, we came up with lots of different scenarios, heard lots of different reasons why people used M-Shwari, and I just want to highlight two very typical examples to try to give a little bit of a feel for this. So one woman told us, my son was bleeding a lot from the nose, and I was just back from the market and had used all of the money. I needed $12, and that money helped a lot. So as I said, this is kind of very typical. This is a woman who has a sick son. She just wants to get some money very quickly. She doesn't want to start a process of going around to family or friends and try to look for money for that $12. From what we can tell from the rest of the interview, this was not necessarily an issue of affordability. Can I somehow afford to pay the $12 for this? It was really, I've just used the money at the market. I didn't know I would need it. Now I have this need, and I want something that's fast, and I want something that's easy. A lot of people also told us that they used M-Shwari for business expenses. So we were a little bit surprised because we said, wow, it's such a small amount. How can that be useful for a business? But here's one typical example. I am in transport business. Not all the time do I have money, so I can borrow money to help out my drivers when they are caught by the police. So these are not business investments for the most part. This is not comparable to an MFI type loan to really build, buy a lot of extra stock to build up your small shop. These are more to cover short-term ups and downs in cash flow. So very similar to kind of the household short-term needs, we find a lot of the same kind of short-term gaps arising in a business setting. So someone owns some taxis or some motorbikes, caught by the police. This is probably to pay a bribe, not the full ticket, of $15 or so, and they just want something, again, that's pretty fast and pretty easy. And we talked a little bit in the last session about interest rate or about the facilitation fee. So one thing to mention is that I think this is a pretty complex issue. I think that the facilitation fee of 7.5% on an APR basis is high. But what we found is that people really also factor in transaction costs and opportunity costs when they look at the cost of the loan. So if we look at this example, if we say that this bribe was $15, the facilitation fee to access this on M-Shwari would be about $1. So again, APR would look high if you did the math, but if you look at the opportunity cost of this taxi sitting around idle for a few hours or half a day while the owner is going around trying to source the money and go bring it to the driver, probably they would lose a lot more than $1 in kind of revenue of just having that taxi parked versus being able to just access it quickly, send it over, and then be able to spend a couple of days or weeks finding the way to replace that money. So those are just a couple of scenarios to keep in mind as we go through, why this has struck such a chord. So I have four kind of things to go through. The first one, and we've already heard some of these, is that it's easy, accessible, and private. I guess those are three different things, but they're kind of related. So easy, we've heard that to open the account is 8 seconds. To access the loan is, I think, 6 seconds. So that just can't be beat by any other sources of credit that exist, I think, as far as I know. Accessible, many people told us I needed something in the middle of the night, or I needed something, fast, or I needed something in this certain location where I was. And I'd be interested if CBA has done any analysis on how many loans are actually taken in the middle of the night, because that's the one that you always hear about. When it's not convenient to kind of call up family and friends and you just need something pretty easy and fast. And finally, private. And we haven't talked much about the savings side. We're really focusing on the credit today. But there are some reasons why we heard over and over again why people do prefer to save in M-Shwari versus M-Pesa. And it's not to do with the interest. And one of those reasons is the private aspect of it. They feel like the savings is 1 degree removed compared to M-Pesa. So they feel like either if it might be just their husband or it might be a thief gets a hold of their phone, M-Pesa is more easy for someone to figure out. They'll quickly look for M-Pesa and say, oh, how much money is on there? They'll forget or they won't realize that there's an M-Shwari behind that. So it feels one distance removed and a little bit more private on the savings side. And of course, on the credit side, same thing. No one needs to know that you're short of money. You don't need to go around and say, oh my gosh, my kid is being kicked out of school. You can just do it on your own. Number two, the product really is governed by some pretty simple and clear rules. It's pretty easy for customers to figure out how to actually just sign up the product and use it. And considering that by now about half the customers are people who've never had a bank account before, that is pretty important. So one interviewer said, the first time you were activating M-Shwari, so opening the account, is there anyone who did it for you? And the respondent said, this is typical, nobody, I just followed the procedure. When you go to M-Pesa menu, there is M-Shwari. It is just logic. Now, for any of us who have worked in MFIs or banks before, trying to get customers in the door and signed up to use their bank account, you do not hear things like this. I mean, it's a very intensive, expensive process from the institution's perspective. And from the customer's perspective, it's confusing and it's intimidating. So the fact that, people feel like they can just figure this out by themselves is a pretty big win. Third one that was pretty interesting, there's a little bit of a double-edged sword to this, but for the most part I was surprised by how this seemed to be a positive thing to customers, is that it's highly engaging and encourages a lot of interaction back and forth with the product. So customers don't really understand the details of how the credit scoring algorithm works. As Greg said, none of us do, although I guess Peace does and Jamal does. So if any of you can get that out of them during the Q&A session, that would be fantastic. But aside from that, it is a black box, and we don't really know exactly what goes into that. But interestingly enough, and this might come back to what Julie said about Kenyans in particular being experimental and open to new things, they really like trying to figure it out. And it really kind of lends itself to lots of interaction with the product, and not as much dormancy as we might see in other accounts. So people know that it has something to do with their transaction behavior or their savings behavior. As P said, they might say, okay, I'm going to put 200 shillings in today, take it out tomorrow, put it in today, the next day, take it out tomorrow, and then I can check my loan limit and see what it did. Okay, that didn't do anything. Let me put my 200 shillings in, keep it there for a week, and then check. Let me see if that does anything. So the fact that people can kind of test out a certain behavior and then quickly check the loan limit and see what impact that had really seems to be something that they enjoy and that kind of keeps them coming back to the product. So one person said, all I do is just play with my money by moving it back and forth. So Peace doesn't like this. She wants them to keep their money in there. But I love to play that game between M-Shwari and M-Pesa. So it is an engaging product. And finally, and probably most importantly, going back to some of what Julie told us, is that the product seems to match the way low-income people think about their finances. So Julie said that Kenyans really care about their money working, and having money in a normal bank account, for some reason, doesn't seem to meet this definition of working. But M-Shwari does. And I think it's because they can kind of kill two birds with one stone. It can be their place to save that 10% that Julie mentioned, the small $6 that they do kind of keep on hand for, for a little bit of short-term savings. But at the same time, that $6 or whatever it is that's in the account is increasing access to credit for when they need it. And from what we could tell, this was less about I'm saving money to get a specific loan for a specific purpose. So this is not really comparable to compulsory savings for an MFI loan. This is more about increasing options for when I might need it in the future. So more similar to maintaining a friendly relationship with a shopkeeper or several shopkeepers so that when you need a line of credit because you can't buy food, you know that you have a couple of shopkeepers who you're friendly with and you can ask them to give you a little bit of credit to buy food. So it's a little bit more, let me keep this here, I can save, and when I do need credit, then I'll have an option to use M-Shwari for that. So those are some of the things that we've seen. I should say, Kate talked a bit about this morning, there are still a lot of challenges. This is a very, very, very new cutting-edge product, and it's certainly one that I think there's still a lot of work to do to try to figure out how to educate customers and how to interact with them. So to give one example of some of the challenges around transparency for customers and having them really understand the terms and conditions. When you do that really fast activation, which customers love, you're asked to visit this website to see the terms and conditions, and then you're asked to accept that you've read the terms and conditions and you agree with them. Problem is, most customers do not have internet access either on their phone or on their computer, and most of them, just accept the terms and conditions without reading it. And so the very feature that customers love most, the fact it's so fast, it's so easy, brings with it challenges. When it's so fast and so easy and you don't do 4 weeks of training in a group setting, how do you get them to really understand some of the details of these things? And P started to talk about some of the things that they do later on to try to help customers understand the implications of not paying and that kind of thing. But that is something that is still a challenge. So just to wrap up before we begin the discussion part, why do we think M-Shwari is important, especially beyond Kenya? It's the first large-scale loan product that really uses a person's telco data, so the big data that's not kind of financial history, to make that initial credit decision, especially in an emerging market. So we talked a lot this morning about the huge, massive data that is out there now about customers in general. Until M-Shwari, applying this to a poor and unbanked segment in an emerging market still was fairly distant. And I think M-Shwari is the first example where they've really done this at scale. And second of all, first successful bank account that's layered on a mobile wallet used by the majority of people in a country. So those of us in financial inclusion or digital financial services has talked for years about mobile money being the rails. And let's just work on getting the rails established really well, and then all these amazing other products and services can be layered on it. But again, until M-Shwari, that felt a little distant. We were all focused on the rails, lots of little pilots of kind of other financial or non-financial products and services that were layered on that. But M-Shwari is really the first product that is layered on those rails that has really grown to scale. And I think has proven that it can be used to bring the unbanked, not just access to mobile money services, but access to the formal banking sector. So it's very much a dynamic story. We are eager to continue to track it and see where it's going to lead us. But these are some of the reasons why we do think it's important and interesting to follow. So at this point, I'm going to invite Julie and Peace up to our apparently not very comfortable chairs. You can guess whether any of us spend a lot of time in bars or not, based on how we sit, and we can have a little discussion. I did warn them yesterday. Sorry, no one warned you. All right, is this on? All right, so I'm going to start with just 2 questions for each of you, and then we will open up to the audience for Q&A. So let me start with Peace. All right. One of the things I wanted to ask Peace about was, we're focused today on credit scoring and big data. We're really interested in especially how that can be applied to the poor and the previously unbanked segments. So I know that recently there's been an experiment that there was kind of a group or a pretty big segment of customers that were considered too poor or too risky to lend to. But I think you've worked with FSD Kenya to try to look at, are there different changes you can make to the credit scoring to kind of try to filter out some credit-worthy poorer people in order to lend to. And that has just launched from my understanding. So if you can just share a little bit more about that and any tweaks you've made to kind of make it more accessible to poorer segments.
Thanks, Tamara. Oh, sorry, Claudia. In last year, we engaged with the FSD to really figure out how can we make M-Shwari relevant to even the person that you'd consider the poor of the poorest. As part of really our value proposition and ensuring that M-Shwari is viable, we unfortunately had to make a decision to cut off some customers who had very low indication in terms of our income levels. The experiment that we did with FSD, and Jamal was a part of it, it was called Toboa, and Toboa in Swahili means breakthrough. What we wanted to find out was, is it really, is our initial assessment of this segment as being high risk true or not? What we were able to do, customers that we initially would have rejected, we opted to give them credit, to say, okay, we'll give you 200 shillings, which is about $2, and see how customers behave with the $2 we give them. Initially, our projections that, the bad debt could be close to 50% or worse. We were surprised, actually, that the bad debt for that segment ended up being 3 times as worse as M-Shwari, but not significantly worse than we had anticipated. What really did we learn from this experiment? Using the customers that actually took a loan and paid back or were delinquent, we were able to go back and design a scorecard and say, the variables that we use in a normal M-Shwari scorecard, does it make sense for this segment of the population? What we actually ended up finding out that actually the scorecard that we had was more favorable for a certain segment, and we needed to replace or tweak some of the scorecard variables to make it suitable for a population of significantly lower income levels. So for us, that was the significant learning we got from the experiment, that as much as we are all taking care of the poor, sometimes a one-size-fits-all may not work for all segments, and we may need to continue learning, taking the risks, giving credit to somebody that would otherwise have denied, and get to learn from them if we really want to broaden access to financial services. Yep.
Great. Next question is moving a little bit away from the credit scoring aspect, but the first session, there were a few comments and questions around the partnership aspect, around banks and telcos, and will they just become one or the other, or how do these two giants kind of, who owns what? So maybe you could just speak briefly. It seems from the outside like you've been able to forge a pretty successful relationship with Safaricom, so maybe you can share a little bit more of how that developed, or kind of how you've divided up the roles and responsibilities, and who does what and why it's worked.
The relationship between Safaricom and CBA goes back to 2007 when Safaricom launched the M-Pesa service. At the time, they were looking for a bank to be their deposit-taking institution, and every institution said, no, this is a strange concept, we don't want a part of it, let's stay away. But CBA really stepped out and said, look, we will be your partner in launching the M-Pesa service. And that's where our relationship began. And when, it came to now setting up, a product such as M-Shwari, CBA definitely became a viable partner in terms of, working with Safaricom to launch the product. The one important thing that has made the partnership work is CBA is okay with saying, okay, you be the face of the product, because the customer has engaged with M-Pesa. They know Safaricom as the face and the brand. It's already trusted in the market. So for us, we didn't feel the need to clash and say, we also want to be visible. We also want the customer to know that we're involved in this product. We said, what we are going to do is we will focus on what the bank does best, and that's banking service, both on the credit and the lending side. What we wanted to make sure that we are able to lend responsibly. We do not stretch our customers in a hope to drive revenue. And sometimes, Safaricom being a telco, they're always excited, like, let's sign up more customers, let's get everybody with credit. But we always remind, from a banking perspective, we have to ensure that we look out for the best interests of our customers and only give credit to customers that can handle it and provide, banking services to anybody that can access it. For Safaricom, having been the face of the product, a lot of the customer engagement goes through Safaricom. They already know how the product works. They already know, how to interact with Safaricom contact center. So we let them manage that. In terms of marketing and promotion, a lot of the customers will always think of Safaricom before CBA. And for us, what's important at the end of the day is who does the customer say is the owner of M-Shwari? But does the customer get value out of the product that we offer them? And that is what makes it work. One partner has to say, I will stick to what I'm good at to make this product work. This is what the customer is used to. Let's continue promoting it in that perspective. And at the end of the day, it becomes a win-win situation.
All right, great. I think I will ask you one more question before I go to Julie, and that is that I mentioned why we think M-Shwari is important beyond Kenya, but one big question which many people had about M-Pesa several years ago, or maybe still do have, and now maybe about M-Shwari, is how replicable is it? How much is it kind of Kenya specific, because M-Pesa has such a huge reach and some of the other specific dynamics. So given the fact that you just launched M-Power in Tanzania next door, maybe you could share just a little bit on how replicable you think the M-Shwari model is globally, or just in Tanzania, what the example has been trying to do this somewhere outside of Kenya.
Yeah. Initially, we actually thought it would be a very quick cut and paste exercise, from Kenya, replicate the model in Tanzania and launched. But we realized there are very different dynamics in the Tanzania market. First, the identification system is not as robust as Kenya. When I was asked to do the credit scoring, I looked at the identification and said, how do we have 20 different IDs? It ranges from a government chief's letter, student ID, bank ATM card. These are all forms of identification that you cannot really pin down and say, I'm going to list a customer based on their chief's letter. Who knows? They probably moved to another area and got a different chief's letter. So that really makes it complicated from even a KYC and knowing on who exactly you're dealing with. The Kenyan market, as Julie had mentioned, we're very experimental. Kenyans love new things. You tell them this can do something for you, they'll try it out. Other markets are a little bit more conservative. They'll start asking questions. What's in it for me? Why should I sign up? It's a little bit of, it takes more to really convince the customer of why this is something that's useful for you compared to the Kenyan market. So I think from that dynamics, we had to really figure out how do we tweak our communication. How do we factor in the cultural differences, especially when it comes to credit? The Tanzania market is more relaxed, especially when someone takes credit and you call them and say, oh, by the way, you have a loan that's outstanding. What's going on? They'll say, yeah, I actually have another loan with KCB, and they don't keep calling me. So it's a very different attitude towards credit. They say, I'll pay you when I get it. They're more relaxed. Like, this is the bank's money. Don't push me. But in the Kenyan market, customers are more responsive to, information and nudges and direction. So for us, I think that's been the really key differentiator. As much as we try to replicate M-Shwari across different markets, it's to really focus on what are the cultural differences? How do consumers perceive savings and lending? What are the type of enabling systems we have? We took the Kenyan population registration database for granted until we realized it's really a key enabler for our product. How do we really ensure that we can verify the customers we're engaging with? How can you ensure that we communicate in a way that the market would understand the implications of delivering our product? So those are some of the key learnings that we cannot just replicate. You have to make it market specific.
Great, thank you. So I guess there's no answer yet on how replicable it is, but you're trying, so we'll be following that closely. So let me just ask Julie a couple questions, and we'll open it up. So one thing that I think is super interesting from Julie's data is that although the diaries was happening just as M-Shwari was launching, so you didn't have a long period of time to track the impact of it, but you have not only the information on how people used the M-Shwari for savings or loans, but every other detail of all their other financial transactions and instruments. So can you share with us a little bit from the households that did open M-Shwari accounts and or take loans, how this fit into their overall financial portfolio, and especially whether what sources of savings or credit it displaced, or did it just increase overall savings and loans that households took on, or just, how would you say that this fit in or adjusted the rest of the financial portfolios of the households?
So we only had 32 people using it, and it was very early on. So the biggest thing that we saw with the people that were using M-Shwari during the study was trying it out. So they really didn't need the credit at the moment, but they wanted to be sure that it would be available when they did need it. So most of the loans that we observed were, hey, they gave me a loan, let me try it out. People mostly who could afford it. So they were the higher income, more urban people in our sample that were trying it out in these early stages. And we do see those shifts that are already happening. And because we had such a small sample and we didn't have them for very long, when we do look at the shifts in their portfolios between when they started using M-Pesa or M-Shwari and before and after, we don't see a trend across those 32. It's just too small. What we do see are the possibilities. So is it possible that this is going to displace certain things? So we do see some that it is displacing savings on M-Pesa. So instead of keeping the money in the mobile account, they were shifting it to M-Shwari, and displacing savings in the house. So moving it from the house into M-Shwari on the savings side. On the credit side, we can only see displacement among those people who regularly borrow. Otherwise, it's sort of a new thing that they're able to borrow. So before, they wouldn't have had any liabilities, and they would be foregoing things. So what we see is new liabilities. But we saw a couple of examples where it was beginning to displace, and people were articulating a displacement of money lender credit. So these were people tend to be working and sort of spend all their money right when they get paid and then sort of stretch the rest of the month. And they would often go to a money lender who knew they had a regular income, was doing their own credit scoring informally. And so we saw some displacement of that kind of credit where they would say, well, M-Shwari is actually cheaper than a money lender. it's more reliable, and it's in 8 seconds. So we saw the possibilities of displacing some of that kind of credit for borrowers, but for most people it was a new form of financing where they weren't really using credit very much at all.
So in these early days, one of the things I did see was that there were some borrowers who were already, even in the short term, becoming kind of repeat borrowers. And so we've talked about how it seems to be primarily used for emergencies or kind of one-off. They want to have the option to use it when needed. However, if they kind of use it and as soon as they've repaid get another one, then that kind of takes away the ability to have that in the case of an emergency. So can you just speak a little more about what you saw and what people were using it for, if they were kind of taking several in a row, and what implications that might have for having it for kind of more the emergency use cases?
So I think there were two sort of scenarios where we saw this sort of perpetual borrowing on M-Shwari. And one was with people who have regular salaries. And like I said, they would get in the habit of paying everything off at the end of the month and then stretching. So they were constantly borrowing, not just from M-Shwari, but from everywhere, every month, and were in the habit of them paying that off when they were paid. So that's one group. The other group are the sort of perpetual experimenters. And we had one respondent who is extremely colorful, and you can read about him in lots of the reports. We call him Collins in the reports. This is a man who is in 5 different savings groups and chairs a women's group so that he can try to benefit from the advantages of the Women's Empowerment Fund and microfinance institutions that might have a preferential access program for women. So this guy is just like super savvy. And he's a perpetual borrower because he's trying to figure out how it all works. And he is the kind of person who will wait and default just to see what CBA will do because he wants to know how it works. And so he just is always borrowing and trying different things. And one time he decided that he wanted to try rolling it over after the 60 days period. So he had no money. So he goes, I think he had like 100 shillings. He goes to the agent and he says, hey, I'm going to deposit. Yeah, I'm going to deposit 1,400 shillings. So the agent already does this transaction. This agent sees him every day. They deposit the money for him. He pays his loan on M-Shwari, immediately requests a new loan, withdraws it, and says, here, take your money back to the agent. So he is not given any cash. And he just topped up the difference of 100 shillings. So he had no cash. He just sort of re-upped the loan. I mean, it wasn't a particular benefit. He's paying the loan facilitation fee again, but he's just trying to get everything right, figure it all out. So that's the other kind of case that we see. But I do think it's a risk because there is always a need to stretch. So for pretty much all of our families, there's probably a time almost every month where you could use an extra $5. And it's very, very tempting to perpetually do that, and it may be for different kinds of needs. So I think one opportunity in the market is to think about more purpose-specific kinds of credit where perhaps the loan is going directly to your school and that loan is a similar kind of thing where it's only one at a time, but it's going directly towards specific needs so that the kinds of things like healthcare and education that we really care about, it's a specific kind of thing where for those specific purposes, it's going to these specific things, and you're not tempted to perpetually be in this kind of loop.
All right, we have a few minutes now for questions. So similar to the last session, please come up to the mic, and Erin will let us know if there's any from the global Twitter sphere.
Hi, I'm Donita Prakash. I'm with Other Division Inc., which is a strategic consulting firm. I have a question about the agents. You guys have talked a lot about the consumers, but the network of 80,000 agents is pretty powerful itself and part of the chicken and egg calculation. Did you just leverage an existing M-Pesa network, or did you have to sell the agents on it? And how did that work? And any learnings you could give us from that? Thanks.
Monique Cohen. I have a question about the diaries and the relationship to M-Shwari. In the work that we've done in Kenya, we found that a lot of the transactions were very short and very limited within family and friends, the social network. And they are small but frequent. Now, you said what I'm interested in knowing is whether M-Shwari replaces those or whether they persist, because they're actually the same size and could be done just as frequently. But they're very important transactions for the households.
Let's do one more.
Thank you. I'm Summer Shah. I work at Axio and Venture Lab with Paul, who spoke in the previous panel. Had a quick question about the average loan sizes that are going out on M-Shwari. I think I saw through some research earlier this year that it was still around $12 USD. I don't know if that's changed. And also interested in we talked about the engaging, how the loan balances can go up over time, and how you guys have seen that happen actually, and what is the typical trend if people start at a certain amount right now, how high is that going over time for consumers? And I know that the target right now actually extends up much higher in terms of loan sizes, but interested to know right now if that angle is something that M-Shwari is really pursuing, trying to get consumers up to a higher level of loan limit, or if the focus right now is still on that small credit, or if it'll eventually get to kind of the loan sizes of around 100 USD that could be used more for independent entrepreneurs, for their businesses, etc.
Great. Okay, why don't we answer those? If you guys want to sit down, I'll remember who you are, so you're first in line for the next set. All right, so Peace, do you want to answer what is the role of the agents with the M-Shwari product, and then the question on the loan sizes, so where they start and what the trajectory is, and then Julie can answer the question on diaries.
Yeah, in regards to the M-Pesa agent on M-Shwari, is the main point of interaction is when a customer needs to either withdraw funds saved on M-Shwari or loans that has been disbursed. So at the moment, all the money that exits from M-Shwari goes through M-Pesa. So when they're interacting with the customer, they will interact with them as a normal M-Pesa customer without necessarily having a bias of whether it's M-Shwari or not. And this is part of the agreement we had with Safaricom in terms of the customer engagement side would always be leveraging on this on Safaricom's infrastructure, both on M-Pesa agent and the customer care center. Okay. In regards to the average loan size?
Yeah, so just maybe the kind of where customers tend to start, what the average is, how quickly they go up the trajectory, or does CBA have plans to kind of make that, are you trying to really increase the average?
Yeah, the current average loan size is about $17, and we try to grow our customers progressively. So we generally review customers' limits within 30 to 60 days, and just depending on how the customer is performing, are they saving, are they taking the product, are they paying on time, that influences how quickly your loan limit grows. On average, it takes about a year to get to the product maximum, which at the moment is at about $500 for the exceptionally good customers and $300 for the normal customers. We try and avoid growing our customers too fast so that we don't get them to a point where they break. So that's why we do a really gradual growth for the loan limits. And that's, I think for us, it's making sure we get the optimal credit limit for the customer and not necessarily getting the customer to the product maximum.
So just to follow up on that, so is the average loan size of $17 still very low because there's so many new customers coming in, and so they're starting kind of from the very bottom? Like if we looked at just the customers who opened accounts 2 years ago, would the average be of those customers kind of much higher than the 17?
I think it's a combination of two things. One is the number of new applicants that come in, and generally you start between $1 and $30 when you sign up for the product. Secondly, because of the nature of our customers, we look at both how you save and how you repay your loans. And as customers also struggle with meeting their financial needs, we also then gradually grow. So it's a combination of the two. The customer's profile, we just ensure based on their customer profile, we grow them to a level that they don't break. And that's why it's a gradual growth. It's not really a high trajectory. And new applicants will come in and dilute the average loan size. So it's a combination of the two.
The question was about whether these loans are displacing what we call resources received, the social network contributions. And I think because we only had a small number of people for a very small time, if this is going to happen, we didn't pick it up. But what we did see throughout the study was the typical household, like 15% of their income from month to month is already composed by these transfers that are regular. So receiving money from your children who are working or slightly better off relatives was very, very common. And that can grow up to a much bigger share for some households that are more dependent on other family members in particular. But we also saw that there's a tremendous fundraising power in the social network when something bad happens. So a lot of money can be mobilized, upwards of 500% of your monthly income from if something bad happens and all of a sudden you need that money. And that's more than most of our respondents could access from M-Shwari, a lot more. So this seems to me to be quite a compliment. So we had one respondent, for example, whose son was sick and needed to go to the hospital. And she took a loan from M-Shwari. I think she got about 500 shillings. That was helpful, not enough. So her brother was also able to send $10. So the brother might not have been able to send the whole 15, but together she was able to put the two pieces together and get the child to the hospital very quickly. So I think at these small sizes, it's really more of a compliment than a displacement. It may be a displacement for things that people that of small size, where people don't really want to tell their relatives about what happened, and I think that that will probably be a good kind of displacement. But the power of the social network for helping people get through hard times, and also just for redistribution, is so ingrained in Kenya that I don't think it's going anywhere very quickly.
All right, let's do the second round of questions, starting with Kate.
Thanks. My question is to Peace, and this is looking at a more kind of dynamic picture on the credit risk management, because you oversee that for the bank. So NPL is, it's a formula set up for banks by the Central Bank of Kenya, and it's for longer term loans. How do you actually look and monitor your portfolio to see like what % of loans are rolling over into the second month, to do some kind of aging of customers and so on, and really see if you're comfortable with the with maybe more meaningful risk management measures than the NPL. And then I also wondered, looking forward, where in the Kenya market and in other markets, a telco could team with an unregulated lender, and you have gone to considerable lengths to, like with your call center, as you said, and customer education, to try to kind of emphasize the consequences of non-payment. But I wonder how you factor that into your overall risk picture.
Hi, Cynthia Newell with Deloitte. This question's for Peace. And I want to caveat it first. Meeting you, I can understand why they're so successful, because you're very impressive. But so I'm curious, so you're talking about, $1.4 billion in savings and $400 million in loans dispersed. That's significant growth. You're already pretty large, but as a bank, how did you handle such significant growth of your institution? What were some key, challenges that you ran into, and some key strategies that you took in order to continue to grow the portfolio like you have and manage risk?
Claudia, Julie, congrats on the financial diaries. Incredible work, and I'm sure it'll be referred in like decades from now going forward. But my question is to Peace, and it's mostly around messaging. So messaging is a very cultural thing, right? And you kind of have charted out the entire customer decision journey in the life cycle of the product. So if you do X, send them Y message. If you do Y, send them Z message. So what are these touch points like? How does messaging vary in, say, Empower compared to M-Shwari? Are these, and for example, as you said, Tanzanian customers tend to be very relaxed and chilled about paying back. How do you tune and fine-tune the messaging in these markets, and what considerations do you take into account?
Let's just do one more, and then Peace will summarize each one in 30 seconds.
Thank you again for your excellent presentations. My name is Dunge Kiti from Kenya, and with IMTFI with the other researchers here. I had just a couple questions. One was maybe to Peace. I just want you to comment on the whole issue about credit culture overall in Kenya versus understanding just to function. Because I think what I heard a lot of you guys presenting was functional understanding of credit versus just the understanding of credit culture versus, I mean, I look at just my understanding of credit culture in this country. It takes time, I mean, for a whole nation, country, to understand that, and I wonder whether those are some of the areas of tension. And then we talked a lot about ownership of data, and we talked industry versus consumer. I'm also curious to hear you guys maybe talk about the whole area of publishing and dissemination of a lot of this information. I mean, you mentioned a paper. I'm just wondering, how much are we feeding back? And it's a question for us in academia too, back into these communities for them to understand the data we're collecting and understanding some of these issues that are being addressed. And then maybe a little bit on the simple question. We collected data on M-Shwari in 8 counties, and we actually had 15 university students from University of Nairobi and Kenyatta University, mostly, and Moi, a couple from Moi University. And we had 4 students, 4 of those students actually had M-Shwari accounts. That's why we recruited them to help us as we collected data. And they were finding understanding the product as complex as university students. And I'm wondering, when you say the simplicity, the whole financial education, we went to a lot of counties where we were told, oh good, the Safaricom people are here. They'll help us understand this product. And a lot of times it was, we're not Safaricom people. We don't really understand it. We tried to get the students who understood the product a bit better. So it's the simplicity, but that was also tied a lot with local language. We heard that a lot. How much of this is being explained in local contexts, in local languages? So I'm just curious.
Great. All right. So that's a lot of really good big questions. We're not going to be able to do justice to all of those in the last kind of 2 to 3 minutes. But, you know, Peace, I'll let you go and let me know if you need prompters on any of those. Just on the very last one, just to say that I think from our perspective, from what we can tell, it's simple enough for people to quickly understand how to open the account and apply for a loan and kind of use the product. That doesn't mean they really understand the details of the product or how it works. And that's the whole engagement. They're trying to figure it out, but they certainly are confused, you know. And so it's simple to use it, the procedures, but not simple to understand kind of the details behind it or the credit. So it's a double-edged sword. But with that piece, you want to do your best in
All right.
3 minutes?
Let's see how many questions I can be able to answer. I think the first question from Kate is around risk management and the NPL. I'm sure we actually take a very conservative approach in terms of our NPL management and delinquency consideration. We age our products like within, you know, central bank has, you know, different classification in terms of normal, watch, substandard, loss, and delinquent. So what we normally do is our product, once you start within the 30-day window, we still consider you as normal. When you roll over, we consider you as watch. After watch, we normally age our product within 10 days. So every 10 days, your loan degrades further. So within a 90-day window, we consider the customer as loss. And, you know, that's how we calculate our delinquent rate, is any loan outstanding for more than 90 days from the date of disbursement. Okay? Did I answer your question? The unregulated lenders, I can't really speak too much to the impact, but what I know for sure is to be able to offer, you know, to take deposits, you at least need to get Central Bank of Kenya license to be able to do that. I think on the credit side, you can be able to lend without that, but for them to be able to do both savings and credit, they'll need to get approval from CBK to be able to proceed. Okay. The next question is around key strategies that CBA has taken in order to, as it continues to grow. One of our main focus was, one, how do we design a scorecard that can really help us you know, identify the risk profile of customers we actually have not been able to engage with. We took pretty tough decisions in terms of let's go a conservative approach and make sure that we don't really create a whole portfolio of a bad book, which could be negative for the entire Kenyan market, I would say. So one approach was, one, to really be conservative in terms of how we develop the scorecard. Start by giving out very small loans and say, okay, let's start the portfolio small, continue growing as we see the customer journey evolve. 3, we looked at how do we tweak our messaging to ensure that, one, we communicate to the customer, whether in terms of this is what you're doing right, this is what you could do differently, this is how you can improve your financial journey. So really continue to have that engagement with the customer. And in instances, whenever we send an SMS notification or a blast, we always track the response rate. If we see that the effectiveness of a message has begun to go down, we say, okay, we need to change either the content or the approach. The other thing we normally do from a strategic perspective is we conduct focus groups. We say, okay, let us bring actual users of the product and say, what do you think about the product? What can we tweak it? How can we make it different? What additional service can we, deliver to you that will make your life much easier and the product more meaningful? So I think from a strategic perspective is really ensuring that we grow our portfolio gradually, and we always monitor how is the book performing. When we're introducing new credit decisioning, we only do it as a pilot first to observe what's the impact to the book. When we're sending communication, whether it's for customer engagement, limit management, we ensure that the message remains relevant. And if we see the issues, we do tweak it as well. And just feedback from the focus group, we see how well we can be able to introduce. Okay, did that answer your question?
I'm just going to jump in 10 seconds on that. How many branches do you have in Kenya?
How many branches?
Yeah.
I mean, for CBA,
yeah,
we have about 27.
27. So your question was about the huge, significant growth. But what's really interesting is that even though they've grown to 10 million more customers last 2 years, they have 27 branches. So this growth is not in hiring lots of new staff, building branches, all the things we would normally associate with a bank growing that big. I mean, this is 10 million customers, and they don't use the branches. So it's a very different kind of growth than we would think of when we think of that huge scale.
Exactly. That's a great point Claudia has made. Is because the account activation is online, we don't have to, have branches all over the country for the customers to